Stand up and make some noise for your Eastern Conference champion, Miami Heat. Number 6, LeBron James. Number 40, Udonis Hayward. Number 1, Chris Bush. Number 15, Mario Chavez. And number 3, Dwayne Wade. Your Miami
All right, welcome everyone. So before we get started officially, just so everybody knows, Stanley's a big basketball fan, and I think he gave up the Knicks for dead. They've been horrible for years. So Stanley, before we get officially started, I just want to ask you one question. That was the fine night. That was the 2013 NBA Finals. Did you go? I know you're a big Miami Heat fan. Did you go to those games in 2013, Stanley?
Is the Pope Catholic?
Enough said. All right, so Stan, you can relax. I'm just gonna do my spiel as I usually do to get the ball rolling. But we're so honored to have you in the house. Um, I just want to say up front, I am so thrilled to reconnect with Stan. He is truly a legend, and he's generously giving his time here. And we'll talk about what he does now and his service a little bit later. But let's just set the stage here briefly. We've had the market got a proper schmeissing for weeks and months on end. It got oversold in the middle of May. I'm sort of a longer term investor, so I'm not going with all the zigs and zags. Stan will talk about the multiple time frames, the short term, the medium term, the longer term. But if you caught that turn, great. Nasdaq I think tacked on 17% or some crazy number like that in 11 days. John Roque has spoken about that repeatedly. I point everybody to John's analysis of the 2002 bear market, where despite Nasdaq falling by 80%, to remind people, hard to believe, the market was actually up on 46% of those days. And there were 10 rallies, counter trend rallies of over 15%, and 15 counter trend rallies of over 10%. And Stanley will get into the multiple time frames later, but my personal belief, and I could be wrong, this is not investment advice, do your own work, all right? I think what we witnessed here is a counter trend rally. Stanley, to your immediate left, if you look at your screen, you'll see our good mutual friend, Tommy Thornton. I salute Tommy. He came in this room 2 weeks ago. I don't know if he was channeling his inner Stan Weinstein, but he called the turn and he really killed it. But he was taking some of his chips off the table earlier this week, having made like a year's worth of performance in about 2 weeks. As Helene Meisler, and we're going to talk about some of your history, Stanley, going back, but as Helene Meisler likes to say, sentiment follows price. And whereas, at the close on Tuesday this past week, people might have been thinking or saying, so you're telling me there's a chance, the dream is alive. And all the talking heads on CNBC and everywhere are saying, get back in the pool. People are squeezing shorts, et cetera, et cetera, et cetera. It remains to be seen where the market's going from here. I'll just read. Stanley was gracious enough to send me his update, the summary of his update that he's putting out this weekend. And I'm just going to excerpt a couple of points here. Where he's talking about that from a very near-term point of view, the tape is very sloppy. It's quite possible that we saw a trading bottom around 1:30 on Friday afternoon. However, it's a very split tape. It's a chop and flop. Various sectors going one way, other sectors going the other. And so, you got to keep the volatility in perspective. Don't lose sight of the forest for the trees. For some of us who aren't as laser-eyed focus on every zig and zag of the market, trying to catch these micro moves maybe too much. So zoom out, as our Bitcoin maxi friends would say. So yeah, there's a short term, but then there's a medium term and the longer term, and Stanley has very different opinions about depending on what time frame you're looking at. So you didn't come in here to listen to me blab on today, as I usually do. There'll be plenty of time for that later. But the man of the hour is Stan Weinstein. I've known Stan for over 3 decades. First met him back in my Fidelity days. He's well known in technical circles. He's kind of like, I would say, one of the senior rabbis of the technicians. And as I was joking, I joked in this room a few weeks ago, and I joked with Stanley on the phone this morning. Neither Stanley nor I are particularly religious. However, in Judaism, we have what's known as the oral tradition, and those are things which are not written down, but it's important. They're important traditions and learnings, nevertheless, which are important, and they're passed on from generation to generation by the rabbis. Stanley's been accused of many things. I don't think being a religious Jew is one of them, so I'm not going to say he is. But I think it's very important that Stanley's voice be heard in the public square. I was joking with him this morning. It's kind of sad, but in a way, some of the more elder statements have been canceled. And it's not because of the political views, it's been because they've been preempted by the change in technology. So, in case you guys are wondering, Stan, I'm going to tease you now, so don't get mad at me. If all you wanted to know what was the serious technology issue we had, was basically getting Stanley to be able to figure out how to get Twitter on his phone and then how to use the Twitter squares. And his grandson, Lawrence, with Tyler Lawrence, was really, really helpful in getting this done. But we had a little birthing pains on this, but we're here. But Stanley, don't worry. You're not the first person that's had this problem. You're not going to be the last. Dennis Gartman, not go down the list. Everyone's had this issue. So, in any event, technology, because the older generation is maybe not as familiar with this technology medium, they're being co-opted. The old guard has been being co-opted or preempted by social media, whether it's Twitter or whatever. And so, in this sort of hyperactive, fast motion market that we live in, where people are clinging on to every bit of news that's driving a lot of the prices. And Stanley will speak to how excessive the short-term gyrations are. But the point is, people like Dennis Gartman, people like Don Cox, people like Jim Walker, people like Stan Weinstein. These are the greats that I've learned from, and they need to be heard. And this room is really always about education, trying to teach people. You give a man a fish, you give him a meal. You teach a man a fish, you give him a livelihood. And that's kind of the way Stanley rolls. So, Stan, maybe a good place to start, because you've been around. I joked with you. You're the kind of the satchel page of the investment business, and you've had a very low profile. And Stanley told me a hilarious story. Stanley, you should share these stories. Something about someone thought you were dead or something. That'd be a great place to start. So, Stan, you've been out of the limelight. I know you did one podcast last year, but what was the story you were telling me that somebody thought you were dead, Stanley? What was that story, Stan?
Okay, here we go. First of all, it's a pleasure to talk with you, George, and the group here in the room. Um, my wife, Rita, and I, before the pandemic, we've done so many cruises over the years. And I guess it was about 3-4 years ago, I was on a ship, one of the ones that we like on a Regent ship. And I saw this guy walking back and forth, kind of looking at me out of the side of his eye. And I said to my wife, Rita, he thinks he knows me. Finally, he couldn't take it anymore. He came up to me and he said, I've got to ask you, didn't you used to be Stan Weinstein? And I turned to my wife, Rita, and said, you see what happens? You don't see me on TV, you think it's dead. And somebody else recently discovered me after the podcast that I did, and he became a client. And he said, oh my God, I'm so glad to see that you're still around. I thought you were dead. And I said, nope, still here, rocking and rolling, still in still in stage two. But I got to tell you, before we even go further, I first want to thank you, and for sure my grandson Tyler Lawrence, or this would have never happened, because technology is way above my pay grade. And if it was up to me, I would still be using 2 Dixie cups and a tight string.
Stanley, you are the satchel page of the investment business. You haven't told you and I haven't talked for a few years until a couple of weeks ago, but I can see you haven't changed at all. You're like a fine wine; you just keep getting better with age. So, Stan, could you just talk a little bit? We're not going to go down memory lane of where you went to school and grew up and the whole deal, But could you just talk a little bit about how you got started? And also, what I want to know is you're kind of the link. You probably you're a lot to a large degree self-taught, but you probably also learned a lot from your predecessors and your elders. So maybe talk about how you got started, and then talk about some of the greats that you knew that are not with us anymore, and how and what you got from them, because these are all just names in a history book to many of us.
Sure. Okay. You're asking a lot of good questions. So it's kind of like you're on the basketball court and you're giving me the ball. You're getting assists as we go. Basically, without going into a whole lot of wriggles and jiggles in the past, started out degree in economics, and it was funny. Years later, I'm jumping, but years later, I guess it was the early 1980s. I used to do a lot of interviews, and the interviewer thought I was being facetious. And he said to me at that point in time, because then I had made the name, I'd been on Wall Street reading the whole thing, he said, Stan, what did you have to learn to do to be successful in the market? And I was being straight up. And I said, put my economics degree on the side. Yeah, he laughed. He thought I was kidding around. But historically, we know that economists make the worst investors, because what do you learn in Echo 101? That the market is really a discounting mechanism and it's looking 6+ months into the future. So what you're reading in the Wall Street Journal, or for sure hearing on CSNBC, etc., is not going to help you with the here and now. So the quick version is that I got out of school, put my economics degree on the side, always was a risk taker, and then turned down a chance to be an economist. Took a job for $75 a week to train as a stockbroker. The rest is history. As in fact, I'm a big sports fan, as you said, and I'll go into my thing. Vinny Lombardi had said, if you read his book, and he was so right, he said, hey, there's an average of 73 plays in a football game, but it's usually 4 or 5 plays, key plays, that win the game or lose the game. And I think it's the same way in life. And happily, my key plays worked out well. So, key play number one, boom, I decided to become a risk taker and go into the stock market and became a broker. Then, important play number two, it's now 1969. We're going into a bear market, and I didn't have all these rich clients, which I had, who I know today. In those days, and was struggling, and I saw the bear market. In those days, very few people wanted to sell short, so it became very boring in the brokerage room. We were sailing planes around the room, and I happened to answer an ad in the Wall Street Journal, which was just a PO box that said chartist, and I said, "Oh, that's me," and I answered it. Forgot about it. A few weeks later, I got a call. It turned out it was from Jack Mora, who in those days owned Indicated Digest. I went, I interviewed with him. It, interestingly enough, they weren't looking for a me. They were looking for somebody who physically drew the charts. But I kind of impressed him, hired me on the spot. Boom. I gave up being a broker, moved on. As history showed, I became editor of the Indicated Digest. They had another publication, Technical Stock Reports, moved on. Next important move, now it's, Justin Mamus and Justin had actually started the professional tape reader. And now I'm still, and Justin and I met, he was an Indicated Digest too. I was now ready to move on. And he said, no, I was going to start my own service. Don't start a service. We can do it together. I left Indicated Digest. Justin and I did the tape reader for a few years together. And may he rest in peace. Justin was a great technician. And then from there, moved on. I became discovered on Wall Street Week, Lou Rukeyser, boom, boom, boom. That was an next important step. Then another important one along the way. Now we get into the 80s, and somebody comes up to me and says, hey, I know you've got this very successful publication, the Professional Tape Reader, but I think you could do even better if you would write a book. And I said, oh, I don't know if I have time for a book. Anyway, he said, I'll write the book. You just have to feed me the notes. So that was the next important play in my life. I did one chapter, a theoretical chapter. I read it. I said to my wife, read what he wrote. I said, this is not me. I bought him out. I ended up, Rita and I, it took 1 year out of our life in 1987 doing the book, Secrets for Profiting in Bull and Bear Markets. Boom. At that time when I did it with Dow Jones Irwin, I said, hey, I know I'm not going to be in those days, Sidney Sheldon. I said, but how many of these things sell? Yeah, we can sell a couple of thousand if it works. I said, great. Happily, I did it. It turned out that it's become a great seller. We've sold now over 200,000 books in 6 different languages. That was an important play. And that led to, I think, my last important call in the Vinnie Lombardi analogy. Then it's now 1989. Another guy comes to me. I was always open to ideas. And he says to me, I think as great as the tape reader is, you could do an institutional product, which became Global Trend Alert. Started it in 1990. Thought, hey, it'd be a little nice adjunct. Instead of an adjunct, it turned out it blew the tape reader away. Again, as I move, now we'll after this talk about the market. I always move incrementally, not would have said, oh, maybe you retire. I said, no, but I always want to hedge, and Rita and I are a team. So I gave up the tape reader in 2000. I stopped doing the radio and TV stuff. I stopped doing seminars, but I did keep Global Trend Alert, which I'm doing to this day. And I plan to do it forever, God willing.
That's
But the
awesome.
bottom
That's
line
awesome.
is, this is where we are now.
Perfect. All right, so that's fantastic, Tony. Okay, so there's so many ways that we can go in this, and you have a lot of friends in the room that I want to work in here. So I'll just ask a few questions, and then I'm gonna I see we have Tommy Thornton in the room, John Roque in the room. I mean, a lot of great people in here. Tony Greer in the room. I know you know a lot of these folks, and I really want to let them speak a lot. But let me just start with a couple questions. So when you look at the frenetic pace of the market, in the turnover and the volatility and so on and so forth. I mean, I guess the basic principles of the market have not changed, but a lot of the way the game is played, the rules haven't changed, but the way the other team is playing, use a sports analogy, right? They're playing a little bit differently. So if it's you against the market, you guys still got to figure out how you're going to adjust to this. So I guess what would you say as you look at the market, and I imagine your hair must catch on fire when you see a lot of what passes for wisdom in the newspapers and the advice that are given. And look, you can't blame a lot of the newer investors. A lot of people have come into the market only since, in the last dozen years since the great financial crisis. What do you observe about the market? Like, how's the market? The market's changed, obviously, but when you look at what people are doing, what are they missing? What do you think are some of the sort of first principles that people are missing as you go back to the blocking and tackling? Because I think you have a lot of these people running around just trying to day trade and weekly options and all this craziness, and we know that's very hard. So maybe just vent a little bit. Talk about what you see and how is it different from what you grew up on. How is it the same? And also how have your rules changed at all? A lot,
Okay,
lot, lot of emphasis.
again, you're leading and giving me an assist and asking great questions. And before I go forward, I hear you mention several times John Roque. I don't know if he's on, but I give a shout out to John because I think he's fabulous and I know him. Some of the other guys you don't
So
know,
so
know them
Stan,
as well.
Stanley, he's just to your left. He's the chart life. John, if you can speak up, if you're in a place right now, John, it'd be great to hear your voice.
Hey, Stan, John Roque, great to hear your voice. I'm so glad to be with you and to have hear you on George's show today. What an honor. I still have a copy of your book that you autographed to me when I visited you at your home. So I want to just sit back and hear, just soak up everything you have to say. I'm going to turn it off now, and I hope to ask you a question a little bit later.
Hey, I'm back at you, and it's great. It takes one to know one. You're a great one too. Anyway, here we go. Again, you could go into such depth with this, but basically, I like to cut to the bottom line. I think they've ruined the market, but you know what? It's the new norm, so you can bitch and moan as much as you want, but you can see that, and it's a series of events that happened between the fact that first commissions were cut in the old days when I was in broker. Oh my God, it was $100+ round trip to buy a stock, one way, and then more round trip. And now you can basically trade for free, for pennies, for less. So there's that reality. Also, specialists. We knew, even though, yeah, they may not have all been the most honest guys, they still definitely had a good function where they balanced their books and whatever. Now you press a button, everything's electronic. The bottom line is they've turned it. It's not a true stock market like it was. I don't mean to sound like an old dinosaur, but it's not a true stock market like we had in the old days, where things took, you had source of bottoms and distributional tops. Now, boom, forget about distributional tops. Things can change and go from the penthouse to the outhouse literally in hours. So it is what it is. And, we have to, adapt to that. It's the new norm. Now, in terms of, my view of the market, it's still the two basic things never change. Supply and demand is always going to be supply and demand. And from a psychological point of view, fear and greed is always going to be fear and greed. So it's still there. But moves, if you go back and you look at my book, I know a lot of people have it out there, and they asked me to do another copy, but I said, no, I'm not doing an update. That's my contribution to literature. But anyway, if you take a look, you see these moves that lasted over weeks and months. Now they're happening so quickly. So you really have to be on top of your game. And I know, without naming names, even some of my long-term clients and some of the mutual funds would tell me, oh yeah, I'm a long-term investor. BS. I'm telling you, everybody to a degree has become a trader. And people that tell me the long term, I see them buying on Monday, selling on Thursday. It's crazy. And I do think that can be an adjunct synergistically to add on to your profits if you do it right. But I'm afraid too many people have made this their end all and be all. And I had written, for anybody who reads my input, I had written several months ago when this bear market started. I do think, by the way, we're in a bear market that started actually in November, December, and accelerated in early January when we had that phony new all-time high in the first couple of days in January in the S&P, but it wasn't confirmed by so many other indexes. You're in a bear market, but this is a very different kind of bear market. And again, anybody who's read me knows that I've said ad nauseum that it's not enough to just get hung up, and I don't want you to get hung up on bull bear semantics, because 1/3 of the market is still in a bull market, 2/3 are bearish. So we had put out a sell on a lot of the aggressive stuff. I don't have to tell all of you sharp guys what they've done to the aggressive area, though a lot of them are oversold now. At the same time, very bullish. We have, and we still have, a lot of clients in energy related stocks. I think the energy is terrific. A lot of my material stocks, still a great rocking and rolling, terrific. My fertilizers, I won't make a bad joke, but I got to tell you, it's never smelled that good. It's been the fertilizers are fantastic, and copper is shaping up. So there are things you could do. I also see money gravitating now and starting to move into the healthcare. A lot of small mid cap on my buy list, medium biotech stocks and some other healthcare stocks. That's good stuff. Also, for my more conservative accounts, utilities. We've been up to a zoo with my utility recommendations. It's like shooting fish in a barrel, and this hasn't changed, even though things are moving faster. I remember writing in the book when my hair was still black, but I'm happy I still have hair, even though it's gray now. The bottom line is, even though I wrote many years ago, I said your chances of winning in the market are so much greater if you have a good chart in a good sector. And that's still true. If I have two equal charts, but one is in a rock and roll sector, let's say like energy related, and one is in just a so-so area, I'll always go with the one that's in the hot sector. And I'm telling you, sectors have become even more important in this new norm than in the old days. It was always important, but even more now, because I'm telling you, I'm watching this. We follow with the staff over 3,000 charts. It goes through like in the in-depth report that I just finished, which will go out tomorrow before working with you, George. I see in here, it's mindless. If they like a group, like when I put out that sell in the beginning of the year on the aggressive growth, boom, forget about the fundamentals, which I never pay a lot of attention to, but here it really didn't matter. They sold them all. And if I put out the buy on energy, yeah, and energy worked, they bought them all from A to Z. There's not a lot of intellect going on here, but I can't judge it. You just got to go with the flow. So I'm telling you, sector analysis is very important.
Stan, listening to you talk, it's hilarious. I have a lot of mutual friends in the room. By the way, I see Walter Deemer just joined us. Hopefully, he's going to speak as well. You have Stan. So many people have come out here today to listen to you. These are people that you've known in decades past, probably haven't had contact with for quite a while. But when word got out that you were coming, it was like crazy. My phone was blowing up. So let's just reset
And
the
by
room here.
excuse me, let me give a shout out to Walt Diemer, who I haven't spoken to in years, but is another great mind.
So it will be great. We're going to get Walter up here on stage, and you guys can talk and maybe have a conversation. And we can sit back and listen. Walter's another elder statesman, senior rabbi type. So let me just reset the room. So we're here with Stan Weinstein of Global Trend Alert. Not to blow him up too much, but his reputation precedes it. Literally, is a legend. I've been privileged to know Stan for over 3 decades. Learned so much from him, and it's just a real pleasure that he's willing to spend his time to share with us some of his wisdom. For those of you that are interested, as he said, Stan is not dead, contrary to what rumors of his demise have been greatly exaggerated. Stan is not dead. He still publishes the Global Trend Alert. I have no commercial affiliation with Stan, but I strongly urge you to reach out to Stan either through Twitter or his website, or if you can't find him, contact me. I'll give his contact details. He's got a great product. Tell him George sent you, and I'm sure he'll take good care of you. So, the Global Trend Alert has been in operation for decades now. It's one of the best publications around. I can't recommend it strongly enough. Okay, so coming back to the market, Stan. So could we talk about it? I don't want to read ad nauseum verbatim your update you sent to me. I kind of know where you're at, but it's really kind of interesting because listening to you speak, it could have been John Roque, it could have been Tony Greer. I mean, it's just eerie, and because I think you have a similar lens with which you look at the world. And you were talking about the disparate tendencies, the chop and flop, whether it's across sectors, across time frames. So for the average guy in the room, Stan, for the average guy, not the sharpies like you and Roque and Greer and Walter Diemer, but for the average guy in the room who's not going to be day trading his account or switching it every 2 or 3 weeks. It's hard. We're all trying to figure this out together, and even the professionals can't figure it all out correctly. But for the average guy in the room, what would you tell them? Let's first go to the longer term outlook. I mean, what's your sort of bigger picture view on the market, and what bets would you be telling them to make? Like, for instance, would you say? I'm just going to channel my inner Stan Weinstein. If you said to me, hey, you know what? Avoid the indices. Don't buy index funds because they're tech laden. John Roque can speak to that later. But put your money maybe in an energy fund or get your money outside the U.S. or whatever. Again, I'm not asking you to get people to fish. I'm asking you to possibly share your wisdom and teach them how to fish. So, what advice, Stanley, would you give to the average person? I guess that's the question.
Okay, again, you're asking great question and leading me. You'd be a terrific point guard. And before I even address that, I just want to quickly say anybody who would like to get, to feel that, they have to come in, but anybody would like to see the in-depth report that'll go out tomorrow, all they have to do, so I don't have to bother you, George, just send off to my email address, give me name, I'll see their email address when they send it to me and put the phone number on it so I can chat with them. And I have a very easy email address. It's Stan, very creative, STN, Stan at Global Trend Alert, no spaces, Stan at globaltrendalert.net. I'll send out the report, and then the big boys and big girls, they can do what they want with it. Okay, so now let's go. I mean, this is such a complex question you're asking, so I don't want to be facile with it. But basically, I had written a couple of months ago. I used it. I always talk in analogous forms. A lot of sports, as you know, of course, I'm a big sports nut. But also I talk in other analogies. And I said I've been through this bear market so many times over the decades, and it always repeats itself. Although this is, very different in some challenging respects. And I use the analogy at the time of a magician. How does a magician accomplish the trick? He uses misdirection, and you take your eye off it, and then suddenly, boom, there's his trick done. I think that applies to the market too. And I warned that the misdirection, because I've seen this in bear market after bear market, was that all of us, and sometimes I got to be honest, present company, me included, that I can be guilty because it's very seductive, that the misdirection is that the market it becomes so oversold and looks so juicy from a trading point of view. And these moves, short-term moves, are so seductive that people take their eye off the trick and they forget the bear market they're in, and they become totally fixated on the short-term nonsense. And I'm telling you, again, without naming the guilty, and some of my clients are in there, um, I get calls, the people, I have two levels of service. Some people just read me. Other people, don't go to the bathroom without calling me, and they pay obviously much more. Anyway, I see it that they call hour after hour. And now, whereas the old days, moves were lasted over weeks, over days. Now, sometimes you're getting intraday bull and bear moves within the same day. There, you can play that, but I stress over and over again, you've got to keep your perspective and separate the one, which is the short-term junk, from the 10, which is the market's got a problem. And then the other 10 is that this is a different bear market than like when I went through, let's say, something like 1973, 74, which was a granddaddy bear market, and everything was an outright sale. This is different. This is, yeah, even though you're in a bear market, obviously aggressive stocks that we put out, they got destroyed, and it turned out to be great short sales, even though I think many of them are now temporarily sold out. There still is, as I said before, that bullish component in a lot of oil related, a lot of other materials, etc. So it's different. But anyway, so I think that what you have to do, if I was to give one bit of advice to somebody who isn't sharp, like all the Johns and the Walters out there, is say, really, first, don't let, as I said before, this short term seductive, sharp near term moves become your end all and be all. But it's, no matter how many times I say it, I know I'm preaching to the choir for the people are sophisticated, but so many people are getting sucked in over and over again, even though they kind of repeat the words and say, yeah, yeah, you're right. And then they'll call 2 hours later and talk about selling what they just bought. You really got to say, okay, I can see putting a small amount of money on the side. Boom, we'll do some trading. It's fun. And I think it's, you can be more successful and going to Bellagio. At the same time, you do have to have an overview and know where the stage 2 long term is. And that's what you'll see in tomorrow's report. I've extracted out. And I think these numbers, because I'm a data driven person, kind of sum up the whole market. We have approximately, I think it's someone, I put it to bed here, I think 157 potential buy candidates if they're going through 3,500 charts in tomorrow's report. But we've got over, I think it was over 250 or 260 potential sells that should be sold on rally, sell breaking down. And this is very interesting because with all of the wild wiggles and jiggles that we've had, and people told me after we happily, I did catch that bottom, 3 weeks ago on March, 14th, but they said, oh, we're in a new bull market. No, we're not in a bull market. But the bottom line is that was very tradable, good rally. But the point I want to make is that throughout this terrific rally, and now let me get this right, in 12 out of the last 13 weeks, in each of these weekend reports that I'm putting out, which we publish tomorrow, there have been more sells than buys. You don't have to be a Mensa to know that in week after week, when you have more sells than buys, even when you're getting rallies, the termites are at work beneath the market's technical surface.
Stanley, I have this vision of the termites eating my house or my portfolio. Oh yeah, yeah. So Stanley, can you come back? I want to bring some questioners in here. I just one more question, and I just want to spell out the order here. I'd like to have after I'm done with my question, we can have Tommy Thornton, and then John Roque, and anyone else who wants to ask a question, please raise your hand. So Stan, I want to come back to the question of time. You mentioned these short term thing, and it's something I've been very focused on as well. And we really haven't had a proper bear market. If you go back to 2020, that wasn't really a bear market. That's really like more like a mistake. If you just put your finger over what happened, it reversed itself as quickly as it relied. And you're old enough to remember when back in the day you referenced the 70s. I started my career at Fidelity in 1981. And we can. I really like Walter Deemer to raise his hand also because he can weigh in on this. He's got some great stories about what it was like back at Putnam. But the old timers would tell you that you come into work in the 70s and you would expect the market to go down every day, and it would just grind you down, and the psychological damage that would occur. was just really debilitating. And so you've always said to me in the past, I remember you say, something's overbought, you can have a bear market in time, bear market in price. But the fact that we've had these, it's almost as if the authorities have King Canute like fashion, have outlawed bear markets. And so the pain is very temporary, and then we go right back to what we were doing before, which is buying. So you're saying there's a chance, as opposed to maybe a less. It doesn't have to be such a sharp descent, but longer in duration, grinding down type of bear market. So, for instance, I was very big in the Japanese market in the 80s. I mean, that's the proper bear market. That went from 39,000 on the Nikkei the last day of 89 to 7,000 somewhere in the OOs. And, here we are at 25,000 or wherever you are. So, Stanley, from where you look at it, man, I know you don't do point and figure, but you have your own way of looking at it. How does the element of time, the fact that it's been so compressed, what has that done to the market? What has it done to investor attitude? And it doesn't make it more complicated because we really haven't had a proper bear market.
Again, good question, and I'll answer. I don't dodge it, but I really think that's not the most important thing, because too many people get hung up in long-term scenarios, and meanwhile, their portfolio gets wiped out if you're going the wrong way, especially in a market that's this volatile. But I do think that, yes, we've had, I even think that was a junior bear market back in 2020, where we had from February down into that March bottom. It dropped like 20%. That was a quick bear market. Some are quicker than others. I think that was sort of analogous what took place in 1987, which really September, October, boom, and that was that bear market. And then you took off again. So, time isn't the only variable. You also have to focus on the intensity. But yeah, like 73, 74 was unbelievable. That was a long-term grinding down thing, which I know somebody like Walt Diemer would know. I went through it. It was unbelievable. And happily, that helped make the professional tape reader in those days, because Justin and I were bearish throughout that whole 2-year period. But that brings up a good point. I can remember, since we're talking about 1973, after the market got schmeiced and got hit hard, it was like in August of 73, we got a good intermediate bottom. And from there, if you look at the chart, that's why I hate labels, because if you stayed short and you didn't play it, you lost a lot of money. But when you had a long overview after that 9-10 week rally was out of the way, the market crashed to new lows. You didn't really bottom until December of 1974. So the bottom line is, fine, it's one thing to look at the long term. And I do think that we're still, in some respects, if you want to play this game, but it's not what's going to make you money next week, I think you're in the early stages of this bear market. And all of you out there who are really technically hip, you don't have to do a whole lot more than look, for argument's sake, like at the Dow chart of the DJI. If you put up the chart of the Dow, you'll see that, even though you temporarily for a nanosecond moved above the 200 and 150 day moving average, this week, and then it moved back below it, the moving averages is still flat. Some people are telling me, hey, Stan, the fact that the moving averages are flat, you're not really in a bear market. Boom, boom. No, I take it differently. I say, ooh, the fact that the moving averages are still flat, you're only in the second or third inning, or use my sports analogy, of this bear market. Long term, you're still in the early stages. You still haven't gotten into the real destructive later stages, where you'll see the moving averages starting to go down and start trending lower. So, from a long-term point of view, I think that's important. Also, if you take a look, you'll see it was only recently that the 50-day moving averages for the S&P, for the Dow, violated the 150 and 200, which is not exactly a sign of overall strength. So you're still early in the game. So I still think you want to grind down things. And here's where, even though I'm 100% technical, if you want to put in the fundamentals, don't get into politics here, but I happen to be very conservative, and I think that this administration, forget it, is the worst thing. It's Jimmy Carter too, except it makes Jimmy Carter look bullish. The bottom line, bottom line is, if you really want to synthesize it, you put the bad fundamentals, which the market's been looking past, with the technicals, where the termites have been taking more and more out of the market surface. I think that the months ahead and the next year could be very bad. But people who want to stop, it's one thing. I talk to some guys. I try to mentor them. Don't day trade all day long. That's all they do. Okay, fine. Then there are others that are the other extreme, that they just have a long. I'm in a bear market, whatever. And meanwhile, they've gotten their asses whipped in the last 3 weeks. And to me, it's like, don't get hung up. And I write this all over and over again. I said, don't get hung up in bull and bear semantics. I'm not telling all of you to be day traders, but I think this is part of the new game. In this new environment, to strictly be a long-term player, to strictly say, I'm in a bear market and you're going to only worry about the months ahead, and not to at least make some incremental adjustments. I'm not talking about day trades, but when you see like an important bottom that was put in on March 14th, I think it's a prescription for disaster. So it's kind of like, again, going back to my sports analogy, it's kind of like you need offense and defense on a good football team. You need a little bit of short to intermediate term feeling along with the long term. And now I'll get, before I turn it back to you, George, long-term, fine, we got a problem. Obvious. Anybody who looks at charts knows that. Intermediate term, it turned positive on March 14th. And I said at that time, first good rally, boom, happily I was right. Then I said I thought it would be range bound. I think that's what it's going to be here, range bound for the next several weeks, right or wrong. When I'm wrong, it'll stand out like a sore thumb because I don't hedge. I get some of these reports here, and I kid around my wife, Rita. I said, they're going to be right no matter what happens, because they've covered 6 ways to Sunday. So the bottom line is, if I'm wrong, it's wrong. I wrote important intermediate bottom, boom. Don't think it. I remember writing this in weekend update after weekend update. I said, not going to be broken though in the next several weeks. I'm not talking forever, but I think we will not be broken in the next several weeks. Think we'll be range bound. Boom. Awesome. Now we broke down from the long term, which is a 10. The intermediate term, we'll say, is a 5 on the Richter scale. Now we get down to the 1, even though it's the least important. That's what I get the most calls about, literally night and day. I've got some clients in Australia. For them, it's daytime, so they call me at midnight. I tell them it's okay.
Stanley, I have to interrupt you, Stanley, which reminds me, you and I used to talk quite frequently a few years back. And you and I used to joke about what I would call the dopometer. You might call them the wrong way Louis. Well, of course, we're going to keep. They're in the witness protection program. We're not going to mention names. But when you look at the odd lotters, the guys who were like your most valuable clients, because you always want to fade what they say, what are those guys saying right now?
They're nauseous. They're literally nauseous because they're whipping themselves. And I tell them, stop. There are times that less is best. And I come back to an analogy. I'm not a tremendous gambler, but I like to play a little bit of blackjack. And again, it's the same rules and common sense in blackjack as the stock market. It's money management. And when the deck gets cold, what do? You put the chips in your pocket, you walk away from the table, you get a drink. Some of these people, I yell at them. I say, hey, you're not an addict. Take the needle out of your arm. The bottom line is, this is the time to walk away from the table and get a drink. And they're day and night trading, even though the deck is not rich. And I watch what they're doing. They're whipping themselves like crazy.
Right. Okay. That's fabulous. All right. So now let's go to questions. I'll tell you what the batting order is. So first, we're going to have Tommy Thornton, followed by John Roque, followed by Shrub. Good to see you, Tommy. What's up? You got a question for Stan?
Hey, guys. How's everybody today? Stan, I was David Gannick's lead trader, and remember at Level Global, we were pretty good clients, and we were the ones that would call you at all hours.
That's in the rearview mirror.
I know. I will say, I'm getting such great memories listening to you because of all the little sayings, boom. You didn't say, you'd say, oh, guys, don't take that trade. That's like hitting on 16. That would be something you would do.
You have a good memory.
Oh, I remember so much. And, the thing is, I've learned so much from you, Stan, and it's really something that I hope everyone will read your book. It is timeless, and I actually on my website I have your book as one of my favorite books, and a link to buy. So hopefully you're a bestseller. I will say that Stan, I miss you a lot. I remember David would say, "Hey, get Stan on the phone," and we'd get you on the phone. And one time, I think you were with your grandkids at Disney World, and you were like waiting in line for a ride, and you still took our call and talked about everything you saw in the market. But I think it's really important that what you're saying uh, really stuck me or hit me way back. You're so flexible with the market and with stocks and sectors, and that I think is the process that everybody needs to learn from you. And I am just, it's just awesome that George can get you on here. And I, you know, I honestly, I'm a little speechless, not really knowing where to go with this. But you're a legend, and so you meant a lot to me when I was at Level, and we had such great success. And I will say that you were part of it. So
I
thank you
want to
very
tell you,
much.
coming from a professional like you, who I respect, I really appreciate the kudos and thanks. That's really nice.
And Stanley, Tommy's, he's a great man. I'm friends, and I think his sentiments really speak for so many of us in the room. I mean, I don't want to get soft on you, but seriously, you've had a huge impact on people. You don't even know most of the people, all right? And so Tommy, I think, really speaks for so many folks. Tommy, do you want to ask a question? Or should we go on to John Roque?
Uh, actually, yeah, I do want to ask him a question. Now, my view, Stan, and I like to when you challenge, or if I can tell you my view, and then you challenge it, or you
Sure.
say you're right on, or you're hitting on 16. Uh, I'm with you that I believe we're in a bear market. And bear markets aren't easy to trade, and usually the harder the market is to trade with these quick rips higher, um, and then the bottom falls out. What's your time frame? I don't know. You're like, oh, don't I can't look long term, but what's your time frame if this is like a real bear market? What is your time frame? 12
Great.
months?
Yeah, Greg, here we go. Great question. First, I'm not going to dodge it, but the here and now to me is more important than my guessing long term. So don't take this to the bank. But I think that we probably have a crappy year ahead of us. That's number one. Number two, I think that it's important that you do break down trend by trend. Um, but I alluded to this a bit, saying that I think you're in the early stages, like the second or third inning only of this bear market. So I think it's, if you want to talk long term, I think and you definitely we're in a total agreement in a bear market. But as I said before, don't get hung up on semantics, because you're in a bear market. Hey, we've made a lot of money in the oils being long in the last 3 months. I've made a lot of money, although I covered it now, being short a lot of these aggressive growth stocks. So I hate to get hung up on labels, but I do think it's important that you do have a feeling of the overview. But I went back, I tried to be specific. A, we're in the early stages. B, and I think it's going to be a while. B, this, you have to understand, this is a bit of a different animal than just a straight bear. Like I said, 73, 74, granddaddy bear market, everything was a sale, but it may eventually turn out to be that, but I don't like to look around too many corners. Right now, I basically would say 1/3 of the market is still in a bull market. And you know where I feel. I'm not going to repeat myself ad nauseum. 2/3 is clearly in a bear market. Okay, so we got that. And I think it's going to last a while. Now, I do think, even that we're in total agreement, to strictly get hung up on the label of bear market and not to address that, hey, the intermediate turned bullish 3 weeks ago, and that, okay, I should be, even if I'm a bear, less short than I was, at that, after that March 14th bottom. I think is crazy. So the bottom line, and the next thing is that it's also ridiculous. This market is moving at warp speed to just stay on labels. I cover the hell out of shorts, and this isn't bragging; it's just reality. Anybody who's who's been with me knows we made so much money on the short side and all that aggressive crap I put out. But at the same time, now that we've covered that, there are new places. Like I moved the money into the truckers. Go look at the trucking charts. You can throw a goddamn dart at all my truckers. Just don't do it on Monday morning because we covered some short on Friday. They got destroyed. Oh my God, they killed them. But now this is what people are making this game harder and being theoretical. That's one thing. I'm a bottom line player. I'm not a theorist. And if I look at the charts and go, fine, I still love the energy, terrific. Hey, my truckers, and also I hate banks. Banks terrible. So if we do no more, and this is why I think people overthink things and they make it so difficult. And even we as technicians, I sometimes find that we fall into this trap too. The fundamentalists, they fall into it all the time because they can't time anything. So they'll give us BS like, oh, you should only buy long term and average down because there's no way you can time the market. Yeah, right. Okay, they cover it. But even us as technicians, we sometimes a little guilty with, okay, we put a broad brush on, we're in a bear market. Fine, you're in a bear market. But you know what? I think a lot of, like I covered the short and the SHOP, SHOP, and the PayPal, PYPL. I don't care if it's going lower. Those are oversold shorts. At the same time, I think it's insane to still say short those when on the next rally, look at anybody who gets the report tomorrow, see it. Look in the next 2 weeks, on the next rally. I think that it's so easy to make a lot of money shorting up the truckers. They look like junk. So short them up and then boom, also not as aggressively, but short up as your rally Bank America, JP Morgan. I think we make the game harder than it has to be. And sometimes we over intellectualize instead of just being a pragmatist and saying, hey, what looks good? I'll sell, I'm going to buy it coming in. What looks like crap? I'll sell it going up. And hey, at some point, if the market turns into like 73, 74, that'll be different. This is not 73, 74. This is a hybrid market.
Awesome, Stanley. By the way, Stanley, just before we go to the next question, someone just asked me back channel, could you slowly please repeat your company's email address? So they want to send you an email.
Sure, here we go. Stan, very creative, STAN, Stan at Global Trend Alert, no spaces, Stan at Global Trend Alert. Make sure it's .net. .net, otherwise it'll be lost in cyberspace.
Yeah, how did you get stuck with .net instead of .com?
Don't ask me. That's what I have staff for.
All right, fine. All right, let's now go to we're going to do John Roque followed by Shrub. Hey, John, are you there, John?
Hi, Stan. Hi,
John.
Stan. Hi, George. Thanks very much. So, Stan, I'm gonna pull the age card here. I remember when you were one of the elves on Louis Rukeyser's Wall Street Week, which was always a pleasure to hear your opinions. But I also remember you as a guest on Louis Rukeyser. That was kind of a special treat. And I hope to, stay in touch with you forever. And I have a few questions for you. So here goes. I hope you don't mind, George, if I hit Stan with 3 questions.
Go for it, John. Go for it.
Okay, Stan. The first question is, I know that you don't get caught up on semantics, and I happen to agree. But if you were Rip Van Winkle and you woke up today and you asked me, John, how are Bank America, Citigroup, Goldman Sachs, J.P. Morgan, and Morgan Stanley doing? And I said to you, they all look like they're sales on my work. What would that tell you about the overall market?
Stop. Let's do one at a time. And John, you know how I respect you. Great question. That would tell me, hey, we better be careful. We all know the game. When the financials look bad, that's not exactly a sign of overall strength. A. The second corollary, before we go on to your second question, but a corollary to that is it also reinforces what I said earlier in this review here, which is that it's almost mindless. I put out to sell another group that we shorted the crap out of with the home builders. I'm telling you, you go take a look. I defy you, actually, maybe you can find one, but I defy you to go through the charts and tell me, oh, here's some good home builders. Some are worse than others, but this is what this market is about now. There's not a lot of intellect going on. When the home builders are bad, boom, they sold every home builder. When the financials are bad, well, not the financials, but the banks, boom, They're selling all the bank-related stocks. The truckers are bad. They're selling all the truckers. Even the JB Hunt, which until recently that hadn't been on my sell list, the others all were. Now they attacked JB Hunt too. I'm telling you, that's telling us two things: the group sucks, and it's not long term very good for the market.
Okay, thank you. My second question is, and you hit it when you wanted to sell, all those software stocks in the early days of this decline, and a lot of those guys are certainly have been down a ton and washed out. What does it tell you now that the deterioration is migrating into the semi space with stocks like Analog Devices, AMD, KLAC, Lam Research, LSCC, Corvo, Teradyne, Taiwan Semi, and Texas Instruments also deteriorating here?
I'm telling you, you could have gotten me to sleep a little earlier last night if you'd come over here and help me write the update. That's all in the update. Yeah, I'm kidding around with you, but yeah, that's the rotation that's going on, and that's what the termites are doing, and that's my point. Too many people don't understand the rotational nature of this tape, and they try to go A to Z, and I keep writing ad nauseum. This is not an A to Z monolithic tape. Yes, now they're starting to roll over and break down the semis, which again is a two-part answer. A, bad for the overall technical underpinnings longer term of the market. B, why stay short, for argument's sake, in a PayPal, which you already made 50, 60%, and now is so oversold. And it's what I call a 4B. A is early in my stages, B is late. It's a 4B. Hey, I want to do like semis, which is 3B. Some of them are early in the topping phase, which is stage 3. Some are 4A, which is early in the breakdown stage 4. Yeah, great question. So the bottom line is that's a longer term problem in the market. The termites are getting more and more sectors. B, from a tactical point of view, I'm a pragmatist. That's what I care about. That's more where you should be looking to short now rather than PayPal.
Okay, thank you. And so here's my third question, and give me a chance to set it up, please. So I know that you're long and have been promoting natural resource related stocks. So we'll just use that as or commodity related equities. I'll use that nomenclature. There have been, I think, as far as I could tell, 4 prior commodity bull markets. They last on average about 15 years, and over your career, you would have seen the 68 through early 80s version, and then you would have seen the 1999 through 2011 version. Do you stop to think, given how many of the commodity related equities are on your buy list, that we have entered into another commodity bull market? And if it is so, that it tends to last for a long time?
Okay, see, great question again. But here, John, you know how I respect you, but here's where I have a slight difference with you. I don't mean to brag, but one of the things that's helped me establish a good record over the many decades is I try not to look around too many corners.
Okay.
And instead of predicting, I like to evaluate as the cards come out of the deck. So I'll definitely say you and I are on the same team. Yes, from my work, I've been bullish on that for a couple of months. But rather than saying, oh, I know it's going to be 2 years, 3 years. I don't know. I know it's not going to end next week or next month. And my approach is, hey, I'm going to be bullish until I turn bearish. A perfect example, going back to 1973, 74, when Justin and I were writing the professional tape reader, and that made us of the day. We started out when we put out that sell in January 73. We had 300 or 400 clients. By January 75, we had like 6,000 clients because we caught the bear market and we stayed bearish the whole time. But the point I want to make is when we put out that sell in January, I honestly thought in my heart of hearts, we all think things. You just shouldn't take it to the bank. I thought, hey, we got a crappy 5 or 6 months ahead of us. Happily, because I follow my system, which I'm bearish until I turn bullish, or I'm bullish until I turn bearish. We stayed long-term bearish the whole friggin' 2 years. And then boom, December, there was a divergence between the railroads and the DJI. January 75, boom, we turned bullish. I didn't know that it was going to be 2 years, but the methodology made me stay bearish. Well, my answer to you is, hey, you're right. I think it's going to be long, but I'm not smart enough, nor do I care, because I'll be honest, I'm a better trader than an investor, and the bottom line is I don't have patience to worry about 2 years, 3 years, 5 years. I'm happy if I'm making money 6 weeks down the road. So the bottom line is that, boom, you're right. It's good long term, and I'll stay bullish, as I know you will too, until it turns bearish, and it is going to be for a while. But I don't know if it's going to be a year, 2
All
years.
right.
I don't
Yeah,
know.
I got it. All right. Great
All
question.
right. Thanks,
John.
everybody.
Thanks, John. All right. So Stanley, we're now going to have Shrub, followed by Tony Greer, followed by Alan Levinson, followed by Michael Kantrowitz. So Stanley, you have brought out the sharpest guys on the street. I mean, this is the draw of Stanley Weinstein. All right, Shrub, how you doing, man? You got a question for Stanley?
I'm good, George. Thank you so much for having me. Stan, I'm a great fan, and I'm very grateful I discovered your book because I come from a fundamental background. I used to run hedge fund portfolios for the last 15 years. And I come from a fundamental background, so this technical image from your book was actually an eye-opener, and it improved my performance and saved me quite a lot of time.
Congratulations that you're now going straight.
Well done. Thank you very much, sir.
So Shrub, you can't. I'm sorry, Stanley. I know we got to stay politically correct here, but what Shrub's really telling you is he came out of the closet. He now goes.
So I want to take you. By the way, I'm to your point about the market now. It's the first time that I'm so invested while I'm convinced it's a bear market. I've been public about it for the last 6 months. I'm fully invested commodities, energy, short tech. But it doesn't feel...
And look at how great that's been for you. You see, that's why you're playing the game right.
I'm going to just stay along with it until it doesn't work, right? That's what we learn. So I want to take you to my favorite chapter in your book, which I have in front of me. I have your book close to my desk, and unfortunately my kid drew over your face, so I apologize on his behalf. He's 4 years old now. So my favorite chapter is Chapter 8, using the best long-term indicators to spot bull and bear markets. And you have the charts of the bear market tops and how tops follow the 30-week moving averages.
Right.
And what's really interesting about that chart, it's that if you look at today, the Nasdaq just from the lows of March, it just rallied up and then just bounced down, reversed down on the 30-week moving average. So I thought that was a very interesting point. If you don't mind commenting as a data point that we have.
Yeah, that's great. You know what? Let me just tell you. So you're so sharp, and that's it. We all make the game harder than it has to be. Go back to what you just said. As you're talking, I just put the chart up here. We should all look together at the Nasdaq comp and put on that chart. It doesn't matter, 30-week, 40-week. I have on my chart 150 and 200-day moving average, which is basically a 30 or 40-week moving averages. And look how in textbook fashion, that's when we put out short-term, not long-term. We put out the latest short-term sell on the market. Look how it failed in textbook fashion, 1 inch below the 200-day moving average. Unbelievable, Just
I know.
Unbelievable in textbook fashion.
Because, and I'm glad that we're having this chat because when George said that he's having you on the spaces, I actually opened the book in that particular page, and then I compared it with today's image, and it was like, oh my God, Stan could have taken this image and put it in the book today.
Right, exactly. And and that's the old BS where they say history doesn't repeat, it rhymes, whatever. History does repeat, and and I'm asked this over and over again by so many people. I don't do many interviews anymore. But Andrea, Stan, I know you have all these theories, whatever, but do they still work in this market? And I say, you know what? It still works because supply and demand is supply and demand, and they just sped up the market to a ridiculous degree. But look how after all is said and done, with all the BS they throw at us, boom, it's still failing where it's supposed to fail. It just is happening so fast. And like I said earlier, what we used to see happen over weeks now literally happens in days and a few hours into days.
There you go.
Hey, Shrub, thanks for that.
Thank you so much, George.
Yeah.
Thanks, Dan.
I want to do Tony Greer, then Alan Levinson, and then Michael Kantrowitz, and then Jeff Garbaz. That's the biting order. So, Tony, welcome. The floor is yours, Tony.
Thank you, George. Thank you, Stan. Thank you for coming on, man. I really appreciate it. I'm a big fan of your work.
Thank you. I'm having a blast. This is fun.
Yeah, it sure is, isn't it? I agree very much with your views of the Nasdaq and stuff. I'm a big commodity trader, and I look across. Even though commodities have rallied so sharply, with the BCom Bloomberg Commodities Index up 25% or so in the first quarter of the year, when I look across the inventories across, everything from natural gas to crude oil to, LME warrants across the metals, inventories are really low. So I see a continuation of this commodity rally. I'm curious, what do you think happens with the bond market? How do you think that works out? I feel like the 10-year yield chart, the Raoul Pal's chart of truth is kind of the trend is breaking to the upside. Do you think that has legs, or I just want to know your thoughts on bonds? Thank you very much, by the way.
Oh, first of all, thank you. Again, you're better in terms of the bonds than I am, but I'll just tell you, and this plays well for me. People will often say, "Do you follow bonds? Do you follow gold?" I say, if there's a chart, I can follow it. So I'll just tell you, we put out a sell on the bonds. Those who follow me know we put out that sell back in December. When you look at your bond chart, you'll see like the TLT broke below first. It went sequentially. It broke the 50, then the 150, 200-day movement.
Yep.
So after having been bullish on bonds into November, and this is why I don't like to look around too many corners. If I'm doing my job right, I'm doing less predicting and more being a good reporter and evaluating. And the bonds, look at how they went from the penthouse to the outhouse. Hey, they were okay. Oh, they broke below the 50. I had guys reduce. Oh, they broke the 150. We're getting in more trouble. They broke the 200 there in December. It's done. And now it's been in stage 4 ever since. But you noticed you had a couple of good rallies along the way. And I think scalping wise, even though I don't play much bonds, some of my guys do. I had them trim the short in the TLT the other day. I think you put in a trading bottom there, short term, near that 127, 128 area. Yeah, and oversold is oversold. You can get a bounce, but the long term bonds are terrible. I think they go lower, but hey, nothing goes straight down. And so I think that, the same way that even the glamour average I follow, had a rally, you'll get a rally. But long term, until I get back into at least stage 1 and make a stage 1 base, bonds, excuse the expression, they suck.
I agree. Thank you very much.
Yeah. So yes, message received, Stanley. All right, let's move ahead now. And by the way, Stan, just so you know, I mean, I've had a number of back channel requests. People, they're going to be emailing you, so you've definitely woken some people up. All right, so let's now go to we're going to do Alan Levinson, then Michael Kantrowitz, and then Jeff Garbaz. Alan, the floor is yours.
Hi, Stan. I just want to let you know that listening to you is like penicillin to my ears. Your answer to John Roque, to his last question, was brilliant, along the lines of one of my favorite poems. I'll just repeat the first line. Keep walking, though there's no place to get to. Don't try to see through the distances. That's not for human beings. So
I love
anyway,
it. Right, I
exactly.
love it, and I think we're all bringing out the best in each other. Because let's face it, we're all pretty sharp. We can all make money in the market, but at the end of the day, we also have to have some fun. That's what this journey is all about. And I think that it's really, from my end, and I hope I'm bouncing it back to you all, a pleasure to meet like-minded people. Well, let's face it, 9 out of 10 people I can't even talk to because you know that they're lemmings. It's nice when you really can have a rap session with somebody else who gets it.
Totally. All right. So, Alan, what's your question for Stanley?
Okay. So the one thing I want to say to you, that you say you're not a gambler. I am a gambler, and I am a handicapper. So the art of handicapping is weighing variables correctly.
Right.
Okay. So there's one variable that I look at that I don't think anyone else looks at, and I'm curious as if to you look at this variable at all, and that's the commitment of traders report.
I got to be honest, not really.
Okay, well, just the one significant thing that I saw 2 weeks ago was in that 5-day rally where you had the biggest rally in a long time, 8-9%.
Right.
The commercial hedgers, which have been short since the beginning of the year with a record short position, Not only have they covered their short position, but 2 weeks ago into a rally, which they almost never do, they got long. And that's kind of concerning to me as someone who's generally very bearish. That's all I have to say or ask.
First of all, you bring some. See, I always like to get additional input. You bring some good input to the table, so that's great. And I'm sure you see, you're successful with your handicapping, and you see the same good techniques that you use to handicap. I think in the stock market, people get annoyed when I liken the market to blackjack, but really it's the same money management. When things are hot, they're not hot, risk reward, and I tell people, when I think they're making a stupid bet, like you said to me, I used to kid around, that's getting hit on 16 in blackjack. To me, we don't think about it. If you are playing blackjack and you say, oh, I've got 11, the dealer's got 6, you don't think about it. You may lose that hand, but the odds are you're going to win most times if you double down. The market is really not that different. If we buy good stage 2 in a good sector, yeah, once in a while we'll be wrong. Okay, we have to handle that. We'll get out when it breaks down, but you'll win most times. But I watch so many people buying stage 4 crap, and then they end up losing, and they end up blaming either their broker or their wife.
Stan, I just want to say to you, the last thing I just want to say is the name of my entities, all of my entities are called overlay, and that's a gambling slang for meaning positive expected value.
Thank you, Alan. Much appreciated.
It all works together.
Awesome. All right, so now we're going to go to Michael Kantrowitz and then Jeff Carbaz. Michael, good to see you. What's up, man?
Hey, George. My eyes lit up when I saw Stan Weinstein's name. I'm 41. I've been working on Wall Street for 20 years, and it was Stan's book. Literally, that was the first thing that turned me on to Wall Street 25 years ago. So I want to thank you from the bottom of my heart, Stan, because it really.
First of all, thank you. Even though I'm almost double your age, I really appreciate that.
Well, thank you so much. So the question I have for you, I'm blushing because I feel like I am talking to a legend. So it's, again, I'm so honored to speak with you. As a technician, I'm a portfolio strategist, so we're always playing the game of trying to explain the why, whether we're trying to forecast something, thinking about what's the next rotation from a macro perspective. And I've always been somewhat jealous of technicians because they always, many of the ones I've worked with have always said, well, I don't care about the why. It's just I see what I see on the tape, and that's what's going to drive my decisions. So over your career, as you know, the information flow is just accelerated, and things have moved faster and faster. Have you found yourself ever focusing on or being curious about the why, or how does that play a role in your process, if any?
Not really. I find that where I've probably made more mistakes is when I try to do what you're asking me, and you get into why. I really think that you should be the ultimate pragmatist and strictly look at what the market and the stocks are telling us. And that's why those of you who in another lifetime used to read the professional tape reader, what did I have in the upper left-hand corner of each issue of the tape reader? It said, the tape tells all. And I really think that's true. And I can't tell you how many times now it doesn't happen because we know that, the SEC and they come in. But I remember back in the 80s and I had a chapter in the book when I wrote it doesn't work anymore because of, they put people in jail now. But we had so many takeovers and we honestly didn't know. And the SEC came in, boom, had probably 8, 9 stocks that we had recommended. And then several weeks later, there were takeovers. We were just following the system. And I would tell them when they come in, you didn't have to be a genius. If the stock, for argument's sake, traded 10,000 shares a day and it broke out to $12 and suddenly instead of 10,000, it was trading 150, 200,000. Somebody knew something. I was just tagging along. Well, it's the same. And now it's a whole different game. But anyway, it's the same thing here. So I really think it's nice if it makes you curious and intellectually curious. But to me, I care less about why. Again, I just care about what is. And what I find interesting, you'll suddenly find out, there was a reason why that happened. It's amazing. But I spend much less time worrying about why. I just worry about, hey, I'm ready to be wrong in the next uptick or downtick.
So that's really profound wisdom, which is lost on a lot of people. So let's move on. This is really, Stanley, I can't thank you enough. Everyone's really, really enjoying this conversation. I'm glad you are as well. As you can see, it's a sort of curated group of self-selecting, financial crazies who eat, breathe, and sleep the stock market like you. So it's kind of like birds of a feather. So I'd like to bring in a couple other questions here, please. So I think next up is Jeff Garbaz, and then and by the way, Walter Deemer's in the audience. Walter, if you'd raise your hand, I'd love for you to come in here. I've tried to, I don't know if you're listening or not, but it'd be great to listen to you and Stan push the ball back and forth. So Walter, if you'd come up, that'd be absolutely awesome. At any rate, let's go to Jeff Garbaz, and then we're gonna do Mr. Wu. So Jeff, good to see you. What's up, man?
Hey, thanks, George. Hey, Stan, great to hear your voice again. We had lunch about 20 years ago at your country club. I don't know if you remember it. Came in and visited, and it's awesome to hear you. I have two questions for you. The first question I have is back to March 14th. We looked like we might have had a bottom in February and also in January, but they didn't materialize. What is it that you look for off of a bottom that gets you more convinced that it's got legs to it? That's my first question for you. I got one more after that. But
let's do one at a time. As I get older, hey, I got to just remember and focus on one thing at a time. Here we go. I think that if you take a look, but each one we actually had three good bottoms there. If we're talking as traders, and three good bottoms, and you had three good rallies going back into January. But the one, if you take a look, the one that we spoke about on March 14th, that had a couple of interesting facets to it. A, if you're looking at the S&P, it was higher than that shakeout in late February. That was one. Two, which I remember writing about at the time, if you looked, even though, a lot of my shorts and the technologies got smoked, you had significantly less new lows. And that's an important short to intermediate term clue, than you did in the prior ones. So I think that was important. But now, if you look at the chart of the S&P, people a lot of the times I feel schizophrenic because I'm telling some people who told me you're wrong, it's going to right away crash to new lows. I'm not saying always going to be right, but I didn't think it was my indicators were oversold enough. I felt that was a good bottom, less new lows, yada yada. Boom, we got the rally. Then on the other side of the equation, other people telling me you're wrong. We've started a new bull market. I heard the same thing in the summer of 1973. Forget it. I don't think we're in a new bull market, but again, I don't care. I just know where I want to be long and short. But if you take a look at this chart of the S&P, it's really like, and this is what I've been writing, I think you're now going to be range bound for a while because you put in that good bottom, but you have a lot of overhead resistance. Also, at this point, despite the terrific rally that you see these guys who are on CNBC, and I always say the only way you can watch that stuff is really to have it with the sound off, or it's going to cost you money. They're telling you, new bull market, whatever. You're in kind of a zone now, and despite this fine rally, my S&P and secondary surveys, my proprietary indicators showing the percentage of stocks that are technically healthy, even though there's been improvement, it's moved up. I'm going by memory. I just wrote it. I think it's like up to like 45% of the S&P is now favorable, 55% unfavorable. I don't consider it long-term bullish until you get above 70%. So there's two factors here. A, it's reinforcing my intermediate call. Yeah, cool. Long-term, no, it's not a new bull market. But again, don't get hung up. Boom, you're in a zone. And I think short-term, you're going to chop around, and there's some good and there's some bad. That was the second question.
Yeah, so the second question is, we've seen the small cap really underperform, and it started underperforming a lot earlier in the process. And do you feel that that there's a better than 50% chance that when we have these bear markets, that not necessarily every single index has to go into a bear market? Or do you feel that ultimately every index has to go into a bear market?
Good question. I think they're already all in a bear market. I think the next question is, which I thought you were going toward, will some come out of it ahead of others? All of them. And you raised a very good point. I really think, even though I didn't turn officially. And I told people at the time, don't get hung up on my official bear market call, because that really wasn't until late December, early January. But if you take a look, I think that a lot of the bear market started what you're alluding to. If you put up the chart of the RUT, the Russell, it started in mid-November. You had that last run to the roses in the Russell in the mid-November there, and then it quickly hit the retro rockets and broke below the 50, the 150, and it was tanking, and that was an important sign of an important divergence taking place, while at the same time you had that phony so-called new all-time high in the first couple of days of January with the S&P. I'm a big divergence believer, and that was such a divergence with the S&P at a new high. The Russell was already at that point not only well below its high, it was breaking it back below its 200-day moving average. So that was it. Now, I think what's going to happen, but don't take this to the bank. I think it's going to be almost like accounting, first in, first out. The Russell got hit the hardest first. I see when I go through my charts, and you'll notice, any of you who get tomorrow's issue, you'll notice in there, I've got my normal stage 1 and stage 2 long-term buys, but I'm also giving trading oversold, sold out, what I call 4Bs, late stage 4 stocks that I think are trades for 4 to 6 weeks, not to buy for 6 months. And I think a lot of that stuff is in the secondary area, which got destroyed since the November top.
Great. George, can I add a third question?
I'm giving you okay. Add it.
Okay, great. So one of the things I do a lot of work on is shorting, and so like the temptation is to take a stock like, say, Toll Brothers, which is down near like a 52-week low, and to short it. But the way this market has become, there's the reversion to the mean trade that's done, and a lot of times those things just refuse to break to new lows. What are things you look at for a stock that's kind of near a 52-week low that would give you a sign that it's going to break below that and like drop another 20%?
Another great question. First of all, let me slice and dice this. We happily put out a short on Toll and all the home builders. You'll see it yourself in January, broke the 200-day moving average. It's great. Now,
well, we have some dead air time. I think it's interesting. If I could, I love the blackjack analogies. In the 90s, we took my team up, and we would specifically play, basic strategy on the $100 table, not to make money or whatever, but to manage our emotional when the markets went against us. And I think it's a good analogy, to just, work through the ups and downs.
You're basically repeating the question that I wanted to ask Stan. I found his book was a counterbalance to me feeling that I was absolutely positively correct in what was going to happen. And when it didn't, my ego took some really bad hits, and I usually made more mistakes after that. And after, going through his book and taking, let's just say, as a trader, my associates and my boss at times, a proctologist exam with a telephone pole without Vaseline would have been less painful on my ego than what they put me through. And the Stan, George, some of the other people, basically got around to pointing out that, don't be so egocentric about being right. Be ready to change your mind. And when you're wrong, admit you're wrong, get the hell out of the way of the market or whatever else is going to pound on you, and just eat your ego. And if you're wrong, you're wrong. That's life. And one of the things, even today, dealing with a lot of younger people and people in the market, one of the things I run into constantly is people wondering why I just seem to be able to admit I'm wrong, or I press people to disprove my thesis, is because the harder, the more assured, the more absolutely I feel I'm right, the more I can lose really fast in this market.
Right. So hold on. Oh, here.
I think we're good.
We're here. Okay.
Yeah,
so
I'm
we
here.
got
Yep.
Stan back. Stanley, can you hear me? Stanley?
Hello, can you hear me?
Yeah, we got you. Sorry
Didn't
about
I
that.
tell you that we should have 2 Dixie cups and a string?
That's fabulous. All right, so Stanley, I don't know where we were, but I think Jeff Garbaz was asking his third or fourth question, and I'm going to get Jeff to tee it back up where we were, and then Jeff, after you, we're going to have Mr. Wu. So Jeff, the floor is yours. I'm sorry about that, Jeff. Jeff, what's up? You were speaking.
No problem. So we got cut off, and actually, I'm heading out. I need to get in the pool before the end of the day and do some yards. But
good investing.
So back to the whole short thing. The most profitable shorts are like the Nifty 50 type stocks or the momentum type stocks, because ultimately they go down the most. What do you look for after stock's been going up for a really, really period of time, and then it starts to kind of fall apart? What are key things you look at there? I'm curious about the other side of the short equation on what.
Okay, fine. That's great. That's great. That's a good incremental question, and that's what I call watch for stocks if you want to be early. I never want to catch the top tick or the bottom tick. That's for liars. And even when you luck out, it takes too long for it to go your way. But the bottom line is, let's say something is late stage 2B, B is late in the stage, and then it starts to no longer move ahead. It's starting to churn, and the earliest sign is you break below the 50-day moving average. I have clients start getting rid of their longs, reducing longs. But if you want to be the first kid on the block, you can put a toe in the water on the short side, and then you move incrementally. You got to crawl before you walk, and then you start later on breaking below the 150, the 200, become more aggressive. Also, again, as I said before, get the group behind you. If you're in a sector, which I know you're negative on, we're negative on, that's another thing. I call it guilt by association. When you start to see, like when we put out the sell in the home builders or the truckers, it was one after the other after the other. So when you see an individual stock is breaking down, especially if there's an ETF for the sector is rolling over, hey, that's the way to look.
Okay, great. Thanks for your answers. They're awesome. Awesome.
That's awesome. Thanks, Jeff. Always good to hear from you. So now we're going to do Mr. Wu, followed by Gilberto. Mr. Wu, good to see you. What's up? Mr. Wu, we can't hear you. Mr. Woodshed, we can't hear you. Hello?
Hello, can you hear me?
You're breaking up. Try it again. Hello?
Can you hear me?
Can I suggest that please suggest you leave the room and come back?
Sure. Okay, I'll do that.
Oh, yeah. Oh, here. Am I in an echo? Can you hear me okay?
Can you hear me? Alan, O'Hare, can you hear me?
Mr. Wu, you
I
there?
can barely hear you. Just barely.
How about now? Can you hear me?
No, Mr. Wu. Mr. Wu. I'm gonna remove you from speakers. So, here. Am I on an echo reverberation, or is it okay?
Nope, you sound good. You sound good.
All right, cool. All right, okay. So let's go to Gilberto. We're gonna do Gilberto and then Gnostic. Gilberto, you got a question for Stan?
Yes, I do. Thank you, George, for this opportunity. Stan, thank you a lot for your time and for sharing the oral tradition of trading with us. I have 2 questions. First, taking full advantage of your experience in the markets, what time period will you say is more likely to reflect what we are living today? That's the first question. And the second question.
Let's do one at a time. That's a really good question. I think we're living history. So there are sometimes I'll take a look. Oh, that reminds me, like for argument's sake, when we had that quick hit in February, March of 2020, that reminded me of 1987. I think this is really not analogous to exactly what we've seen before. Maybe something like late 70s going into early 80s, which was sloppy and whatever, and commodities are strong there. But I think it's less important because we're really living, I think, a very different, challenging environment, and I think it's somewhat of a mistake to try to pin it down to, oh, this was like that, and then it's going to follow that. I think what we should really do is just know we are living one of the more challenging markets. I don't mean to be histrionic, but that I've seen in my 55 plus years of playing markets. This is really difficult. So let's not make it harder. Let's just focus on, we know we have a long term problem. We know we put in an intermediate bottom. We know we're probably going to be range bound. We know that there's some good stuff that on corrections I would still be buying, like in energy commodities. We know there's still a lot of bad stuff. And we especially have to focus on the bad areas, like on rallies, home builders, banks, truckers, semis are first joining the negative parade. We should really do that, in my opinion, more than trying to think like and pin it down. This is exactly like 1973, or this is like, 2008. I don't think that's going to be profitable. I think we're living a hybrid that's really challenging.
My second question, first, thank you for your answer, and it's going very in line with what the impression has given me. And the second question is, and it's inspired in many of the ideas Professor Plum, Michael Green, who is in the audience, usually talk about passive flows. In terms of how the money is flowing into the indices, how you think these passive flows have changed through the years the behavior of the beer markets. It's possible to affirm that the generals of the Nasdaq has, because of these passive flows, a different way of behaving than in the past?
Yeah, that's another great question. There's not a question in my mind. I was alluding before. I think that what you're just saying with the money flows, the ETFs, the fact that we have this instant trading of just pressing a button instead of specialists, so many factors come together. Not a question. It's changed the game and made what I consider to be the new norm. But I'll let you guys, who are smarter than me in this area, think about why. I just say, hey, it is what it is. Again, being a pragmatist, it's made the game so much faster. I also think the good question that you raise also goes back to what I said earlier, how it's almost mindless when I turn negative on a group or positive on a group, how without them worrying about, oh, that's a good fundamental company, that's a bad fundamental company, they just almost go A to Z within the group. I'm sure that the whole ETF reality, that's affecting it. It all is. But see, I spend less time theorizing why it's happening. And like I said, we can bitch and moan as much as we want. I think to a great degree, they ruined what was really the greatest game that we ever had in the world here with this terrific stock market. You know what? Hey, a half a loaf is better than none. This is the way the market is now. I don't love it, but you know what? We got to adjust to it. And I think what you said plays into it.
That's fantastic, Stan. Thank you for that, Gilberto. All right, we're going to go back to Mr. Woodshed and then a follow-up question from Alan Levinson. Mr. Woodshed, floor is yours.
Awesome. George, can you hear me now?
Yeah, we got it. You're good now. Go ahead.
Awesome, man. Firstly, I just want to say, Stan, it's an absolute pleasure. And George, you're absolutely brilliant. I love how you bring in these old Gs and bring them to Twitter for the first time and let us hear them. It's absolutely fantastic. So really, really well done, man. Keep it up as well. So I have two questions, if you don't mind, Stan. First is, can I get your technical view? Look, I day trade Nasdaq futures. That's all. That's the only instrument I really trade. And I've seen it was above the 200-day moving average all the way from the COVID crash at the end of March up until the end of last year. And we've backtested it 3 times this year. 3 times, including last week, and we've failed. So what do you think?
Okay, here we go. That's also addressed. Any of you will get my report. It's addressed in it. I think you're obviously a very good trader. And you made an important thing. First, we make the game harder than it has to be. You summed it up perfectly. Look at how throughout that whole rally, even though there were nasty corrections along the way, once we put that bottom in back in 2020, after that April bottom, late March, early April bottom, once you went above the 200-day, every sharp reaction held above, in textbook fashion, above the rising 200-day MA. It was beautiful, and that's why that was the game to play. Then, in classic fashion, note how you made a head and shoulder top. It looked like the Hunchback of Notre Dame, how you made a head and shoulder top there as you went into late 2021, the beginning of 2022 there. And that's when I think the whole aggressive game ended. We put out the sell on all those aggressive stocks, and boom, they killed them. And then now, in textbook fashion, you're right, there were three, but this was the best of the three rallies. And look how it failed just 2 inches below the 200-day MA. So now, especially as a day trader, we put out a sell on those aggressive stocks last Tuesday night, Wednesday morning. I'm sure you saw in your own trading that it got very sloppy on that Tuesday, Wednesday morning, Tom, and we got hit hard. Now, this is strictly trading talk because I'm talking to you as a day trader, so everybody else don't take that too seriously. But I covered for myself and for clients a lot of Q shorts and the aggressive stuff on Friday afternoon, I think at 1:30 in the afternoon. And I may be wrong, but I always kid around and say when I'm trading, I shoot first and ask questions later. So the bottom line is, it looked to me like you were putting in a trading bottom. I didn't go long it, but I put in trading bottom, covered a lot of those Q shorts. I don't think you're going to get above the 200-day MA, but if you're talking as day trading, it'll be easy enough to know if I'm wrong. If the comp, which closed at 14,269, closes below, let's make it 14,100. I'm wrong. As a day trader, you'll get 2 more days. If, which I think 2 out of 3 the odds are, you don't break below that 14,100, I think you'll put in a BS trading bottom here. I'm not going long, but I think there'll be a bounce, and I would not short until they bounce you up.
Great. Thanks very much for that. I'd like to just take a brief second here, Stanley. I don't think you were aware of this, and some in the room are, but I want to update people on what's going on here. I mentioned a couple of months in this room that I was thinking of we should devote our energies to charitable endeavors, and there'll be more news coming out on this in the next couple of days. But we do this for free. It's just guys trying to help each other. No one has a monopoly on the truth, and the number of wonderful compliments I've gotten from people saying this is fantastic, bringing people like Stan into the room. Nobody pays for this. Stanley does it because he's a good guy, as all the others that have been here, John Roque, Mark Newman, et cetera, et cetera. So what we're going to be doing is that we're setting up a YouTube channel. So all these recordings of these rooms will be uploaded to the YouTube channel. And at the same time, we're going to be enabling people. We're going to have a link to a charity that people say, I've had numerous folks DM me saying, George, this is wonderful. What's your favorite charity? I want to give some money to a charity in your honor, et cetera, et cetera. So we have selected a charity. It's got universal appeal. It's apolitical. It's World Central Kitchens. Actually, it gets a very high efficiency rating from in terms of what they do with their money. Anyway, the charity is going to be World Central Kitchens. This should be up within the next 24, 48 hours. It's going to look kind of primitive and authentic and raw, just like our rooms are. It's not going to be fancy, but you're going to have all the recordings of the past rooms up there, and you're going to have a link to give to World Central Kitchen. And by giving through that link, they will let us know how much our rooms have raised. And if you're concerned, as I am, about the horrible things that are going on in the Ukraine, we all want to give back. I know we're all so busy, but we're all very fortunate in this room. We have money. This is a high-class problem to have. We're talking about how to protect our net worth or increase our net worth. I don't think it's too much of an ask. None of it goes to me. It's going to go to a charity. I think this is going to revolutionize what's going on Twitter. No one has, the scalability of Twitter and the way you can reach so many people. I think we're going to raise millions of dollars. But as Stan would say, you have to walk before you run. I'm involved in this bike ride, this annual bike ride in Massachusetts. It's been going on for 40 years now. It's called the Pan Mess Challenge. It started out with 10 guys riding across the state of Massachusetts to raise money for one of the fellows' mothers. She had passed away from cancer. So they wanted to raise money for the Dana-Farber Institute. I think the first year they raised $20,000. Here we are 40 odd years later, and I kid you not, I think they raised over $50 million last year, all for Dana-Farber Cancer Institute. And so, we're in a very fortunate position. I do this for free. Stan does this for free. Mark Newman does this for free. I mean, John Roque does this for free. Everybody's come in this room. Michael Green and Michael Kantrowitz. We're going to have you speak one of these days too, and it's all going for good cause. I think we can raise millions and millions of dollars. So it's a start. But Stan, I just want to let you know that it's from content. It's content. It's people that makes guys come to this room. I think we have the best rooms, period, bar none, on Twitter. This is the real deal. And so, Stanley, I thank you for your contribution. I just want to give everybody a heads up that's in this room that we're going to have a YouTube site up and running within a couple of days. So, enough of the commercial message. Mr. Woodshed, did you have another question, or were you
I
done?
did. Thanks, man. Stan, I know you're a technical guy, but I have to ask you a macro question because you traded in the 70s and 80s, and not many have, right? So what do you think of Paul Volcker and what he did? And how does it compare to the modern day Fed? And what was it like to trade back then? And look, I was a kid then, but I knew what he did, eventually stop the inflation problem. But my dad also lost his house, right? Because of the interest rate and he couldn't keep up with payments. So a lot of people got hurt as well. So I'd be interested to know what you think.
Okay, well, don't take my opinion here as seriously as the technicals, but I am interested in politics to quite a degree. I think, unfortunately, we could use Volcker back now. Don't even get me going on Powell. I think he's a lightweight, and he's so behind the times. He's so slow. He would first be buying when the stock is going into stage 4.
Stanley, since we're all sports guys, there are a lot of Fed watchers out there, and I think it's a waste of time because I don't think anyone has a particularly good idea what the Fed's going to do. I'm not even sure the Fed has a good idea what they're going to do.
I was just going to say.
Yeah, exactly. But here's what I ask you, Stanley. The Fed is always engaging in so-called open mouth operations. They're going to do this, they're going to do that. They're thinking about raising rates. They're not even thinking about raising rates. So yada yada yada. Okay, fine. But forget about the open mouth operations. Stanley, in basketball, I don't know if you how much you play as a kid or you certainly watch. They always say when you're playing defense, watch the belly button. The hips don't lie. Watch the belly button. All right. Forget about faking with the ball in the head and all that kind of stuff. Right. The Fed can talk all they want. I know we don't want to go down this rabbit hole. I just want to make an observation and get your reaction to it. Forget, it's watch what they do, not what they say. The fact of the matter is the Fed balance sheet's still been increasing just up until recently. So I just think they've excessively relied on open mouth operations. They're so far behind the curve, they can't even see the curve. I mean, what would your take be on that, Stanley?
Yeah, George, you just summed it up perfectly. And again, I don't want to get too much into the fundamentals, but I think this is going to be part of the problem if you're going to look for an excuse a year from now. Why did the market screw up? Forget that, hey, would have done what it should have done anyway because it got overvalued and all that stuff. I think that is going to be part of the fundamental reason. They were so slow. It's ridiculous. And again, I'm not going to get into politics.
Yeah. All right.
But let me finish this.
Yeah.
When you've got a moron like Nancy Pelosi telling you that by spending more, you're actually fighting inflation and helping the deficit, we're finished.
Stanley, I love you, man. You know what? We're going to have another room. We're going to check IDs at the room because it's going to be the real deal, according to Stan. So none of the snowflakes will get upset. But let's just leave that aside. All right, let's just move on here. Plow ahead. Alan Levins, you had a follow-up question for Stanley?
Yeah, just quick information, then quick question. Quick information is the commercial hedges are long the Russell and short the S&P, by the way. So the question is, let's talk about when you're wrong. Let's talk about your process when you're wrong. Thank you.
Great. That's terrific. I remember, I don't remember if it was chapter 8, but one of the chapters in my book, I remember one of the first books I read when I was a kid was Nicholas Darvis, How I Made $1 million and $2 million in the stock market. I only talked about his good stuff. I put a chapter in saying, hey, I think what really makes you a winner, only the liars are always, right in the stock market. The same way when you go to the racetrack and they show you the winning tickets, they don't show you the losing tickets. So I think even if you're only right 50% of the time, if you play the game right and you get good stuff and you let your winners run and you quickly cut your losses, with proper stop losses, you'll, at the end of the day, only need a creative accountant at the end of the year. But I honestly think that you can be right easily 70, 75% of the time if you play the game right. But anyway, when you're wrong, it's very simple. I put a stop on every single recommendation. I have a trading stop, an investing stop, and I never argue the market. I love when people say the market's wrong. The market's never wrong. We're wrong. We're not in gear with the market. So if it doesn't work out, fine. And I refine my trading, and that's more intermediate to long term where I'm doing. And you got to separate what your game is. When I do my short term trading, in this market, I'm even faster. If let's say you're buying XYZ on a breakout, it's going above 20, boom. Now, in the old days, I would make it only close above the level because you get false breakouts a lot of time. But in this market, because things are so fast, you wait till the end of the day, it breaks out at 20 and change. You can pay 25. So the bottom line is I move in increments. If it moves above my level, let's say at 20 and a 20 spot 10, 20 spot 20, you buy some stock, boom. If it works well, at the end of the day, it's not stupid, but it's above 20. Let's say it's 20 and a half. I buy some more. If you buy the initial, when you're trading, you buy the initial amount going above 20 and it's not working. It's screwing up. It's a false breakout. At the end of the day, it's closing at 19 spots 75. I kick it out and I'll come back to fight another day. False breakout. So it really isn't that difficult. If you have your rules and you follow them with discipline, to me, I don't overthink things. I'm mechanical. It's no different than when I played blackjack. I don't do a lot of thinking. I've got 11. The dealer's got 6. Boom. I'm doubling down.
Just Stanley, let me just follow. It's an excellent question from Alan with Sharp Cookie. And by the way, you have to know, Stanley, I think I mentioned this to you. Alan, he's sort of one. He's in the secret admirers. He's in the silent majority or whatever. And he sent me a compendium a couple weeks ago. I think I mentioned this to you, where there were, I don't know, a dozen or 2 dozen great technicians, maybe 500, 600 pages long, and he circled the part. It was 25 pages. I owe it to you. By the way, Stanley, I tried to send it to you, but the file was so big it wouldn't send. So maybe I'll have one of the tech guys figure out how to do this. But in any event, you were prominently featured in that. The question I asked, just to correlate to Alan's question. So okay. So you never get in real trouble because you got discipline. All right. So you got stops. Fine. Okay. The flip side is if something's really volatile and your stops are too tight, like, what do you do? And I'm going to come up with a real life example. I'm going to make the general question come up with a real life example. What do you do in cases where you set the stop too tight? You get shaken out because it dips a little bit, hits your level, you're out, and then it goes back up and to the right. I mean, you have rules to get back in. And
Yeah, you're right. Absolutely.
Stanley, I'm going to give you a real live bullets right now.
Go.
So let's take energy. Okay, energy has done nothing. All right.
Well, I'm sorry, George. Which stock?
I'm talking about the energy stocks generally. The energy group.
Yeah.
Energy group. Okay. All right. So energy is leadership. It looks strong, multiple time frames. It came out of a huge base. Blah 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 blah. Let's not even talk fundamentals. Forget about the fundamentals. Right. So you take energy, and throughout much of last year, there were a couple times where it wobbled, and maybe it went off your buy list as a result. But then it reasserted itself. So just take energy right now, right here, right now. Okay. It looks great. The worst thing I could say is it's maybe overachieved in the short run, so it needs to consolidate. I don't know, but speak to, it's leadership, but it may have a wobble here or there. And so, how do you think about the stops you put on? I don't know if you probably don't explicitly use a Bollinger Band, but you probably have some idea of trend. So, how do you think about setting stops on energy, just generically, not a particular name?
Great.
If you were to take the XOP or the XLE,
I've got that up. George, I think you're right. So let's take off. Everybody who has it in front of their charts, flip the XOP. I think that's a perfect example. First, it's really been bullish. If you go back since last September, whatever, it had one day. I think it shook out for one day in December below its 200-day MA. Beside that, it's been nonstop bullish. So that's number one. Number two, it's obviously had, now separate long-term from short-term, it's obviously had its troubles along the way. Take a look and decide what your game is. From a trading point of view, if you have the chart up, you'll see in October, November, it rolled over. Yeah, we had clients do some trimming even before it broke. Then it broke the 50-day MA. It doesn't matter if I'm right or wrong. I'm robotic. We did further trimming there. Boom. It had a bad lot of weeks after that. Then the follow-up on your thing, It went back above the 200 AMA. If you want, you re-enter a little, fine, boom, boom, boom. You got shook out again, okay. Then it had that nice breakout very cleanly in February. And if you take a look, since then, it's had a couple of sharp corrections, but did any of those corrections break below the rising 50-day MA? Forget about the 200. No, they held in textbook fashion. The first one in late February, even when the market got schmeiced there in that late February, it held right at the 50-day MA. Then if you take a look at the next one in March, it didn't even quite get to the 50-day MA. So trading is one thing and fine, but if you even if you did some trimming, because I always say profit taking is not a dirty word. Boom, then when it breaks out again, you can do it. So the essence, and it shouldn't be an all or nothing play. Separate your game. Long term energy has been great, and the oil related has been great for months. That's easy. Then along the way, of course, you're going to have some short term hiccups. So you take some off, it breaks out, you put some on. And as long as you know you're trading, if the XOP now closes above, let's give it a little wiggle room, make it round number 139. You closed on Monday above 139. Yeah, I could buy a little more, but no, define your risk when you're going in, because like you said, George, you're very right. It's certainly you're not the first or second kid on the block here. So if you're going to do it, if you're going to do it breaking out this new increment, I'm only talking about the new increment, I would put a stop. I like round numbers. So the recent low was 134 and change. The round number for me is 134. I'd stop it out at 133.99. That's it, and then let the chips fall where they may.
I got it. So you're using the recent local low as your stop, basically.
Right, as a trading stop.
I understand, but investing is different. Okay, that's fantastic.
My God, investing, and you got to define your game.
Yeah, no, you got exactly. Thanks for that, Stan. All right, I want to go to Mark Newman and then Gnostic. Hey, Mark, are you there? You got a question for Stan, Mark?
Yeah. Hey, how you doing? Just want to say, your book is one of many of the legendary books that you read when you want to learn about, about the markets and how to make money and how to have discipline.
Thank you very much.
So you said something interesting earlier on at the very start here about the magic trick, if you will. And I just wanted to sort of equate one thing and sort of say, the macro conversations that I have involve the magic trick, the look over there as sort of what's going on in Russia while we have a lot of problems here in the US, whether it's inflation, whether it's gas prices.
Good point.
And that's it. Just when you said it from the technical perspective, right? Like, don't be misled in the short term. It's like the market is thinking that, and the macro story is sort of, hey, it's Russia, it's the Ukraine, that's what's causing all the inflation. No. But that's the misdirection. So it was interesting to hear it from the technical thoughts that you had to when I, parallel that with the macro
by the way, and also parallel with the BS politics. That's a great point. Anybody who wants to be data driven, they try to say, that, don't get me going, that Psaki, who's a moron, that Jen Psaki, if you take a look, she said, it's all Putin's fault. Just look how gas was rocking and rolling. Look how inflation was skyrocketing before Putin.
That's right.
Stanley, 100%.
And then I just wanted to just one other thing. So you said about, and then you also said about the intermediate term versus the longer term or whatever that may be. We got to remember that in March of 00, spring of 00, the market peaked around 1550-ish, I believe. Between there and September, 6 months later, it got to 1535, right? So in that 6 months, I remember sort of April, May, there was a big downdraft. Then it rallied, and then it went sideways. And in all that time, we had that rotation within there. What was sort of working, what might have been working, what might not have been. And then by September, hey, we're only 1.5%, 1% from all-time highs. Well, the next 18 months, we were 50% lower, right?
You are so right. And I love that, because in last week, I love talking with you guys. In last weekend's update, not the one you'll get tomorrow, in last weekend's update, I went through that exact point, and I said, hey, just what you said. I said back in that point in 2000, it was a good. I said bear markets can have rally. That was a good one. I went back, which I said about the 1973 good rally, but there was also not as good a rally. But in 2008, in the first quarter, yeah.
Hello?
Are you still there?
Hello? I lost you, Stan, for a second.
Stanley.
Okay, good.
Stanley, wind
Wait,
back 10 seconds.
am I still? Am I still on?
No, Stanley.
We got you
Okay,
now.
listen.
Yeah, no, I can hear you now.
Okay, listen.
We lost you for 10 seconds.
Okay, good. The point is, bear markets, I wrote last week, can have good rallies. So you make a very good point. And this is where, again, misdirection comes in. And this is also why it's so important that we don't get hung up on labels of bear markets. You made a great point. Come on. Right now, markets are moving so quickly day by day. Back in 2000, I remember, because we had turned negative there in the first quarter of 2000. But if all you did was be negative and you didn't realize that, the internet and tech was going to get hit there, but a lot of other stuff was up okay until September. It's insanity. So this is why I really think, as I was saying before, and I said in this conversation, fundamentalists BS and tell us, like, you can't time the market. But we also, as technicians, sometimes fall into that trap. Our trap is to only talk long term and not realize in the real world, hey, there's stuff in between.
Yeah, I think that's right. I mean, Tommy Thornton nailed that about 2 weeks ago, right? I think that's very important
100%.
that there are those interim spots. Now, just the last thing, we've been talking about these yield curve inversions and economics, recession, and all these things. You see how those banks act. Citigroup, 1 year low. XHB, the home builders, 1 year lows. Like, those guys are telling you that the yield curve is a big deal.
You're right.
When there's a lot of others that are saying it's not as much, but
those
sectors are speaking to us. Right? I think
by the way, you're right, important. As are the truckers.
Yeah.
100%.
Anyway, I just wanted to say thanks. And Stan, great to hear your voice in this space. And
I got to tell you, this has really recharged me, because it's great hitting back and forth with you guys who are sophisticated. I love it. It really recharges me.
And thanks, George. Thanks, guys. Have a great one.
Thanks, Mark. So, Stanley, I don't want we've been doing this for 2 hours. I want too much of your time. How are you on time, Stan? This room, I just got
we're going to wrap it up. I'll give you another 5-10 minutes, and I got to go. I didn't think it'd be this long, but while I've got you, one more, because I'm terrible when it comes. People are sent to websites I don't know. Twitter. Before you got me on, I've never been on Twitter. So anybody who wants tomorrow's report, I'm going to say it one more time. Just send me off an email, but email that, even at my technological retarded level I can get, send it off to Stan at Global Trend Alert. No spaces. Stan at globaltrendalert.net. Just give me name, and your phone number. I'll send it to you, and then you do what you want with it.
Perfect, Stanley. And I will tweet out your email address so people will have it. No problem. All right, so we're going to wrap this up in 10 minutes. We're going to go in order. Please keep the questions tight, because this has gone on much longer than we thought. We're going to go to Gnostic, followed by Carpathia. Gnostic, good to see you. What's up, my friend?
There we go. Gnostic, yep, I'm here. Yeah, I'm here. Just had to get some lunch. Questions already. It's great.
Hey, Gnostic, you're going in and out. We can't really hear you very well. Can you get to a better place, please?
Yep.
All right, get to a better place. All right, Carpathian, you're up. What's up, Carpathian?
Hey, not much. Thanks a bunch for this, George. Stan, you're a hero. I read your book. Oh, it saved me, who knows what. I just want to, the sports analogy that keeps coming to mind in this call is volleyball. You said we're historically, no one's ever been here. No one alive. We all have experience, but no one alive had this set of data points in these game pieces. The Fed, where they're at, the global central banks. I saw Mike Green on here. He got the passive bid. But, volleyball, you make a point, you forget. You make a point, you forget. And this is so refreshing. It's not really a question, but, volleyball is the one sports analogy. You go on a 5-point run, you got to forget it. It's the next point. And, it really, we have our thinking what's going to happen, but it is so far down the Thunderdome. We just got to, read and react and ride with what's working. And it's the materials. You devalue the denominator.
You're totally right. And also, I love, I never use volleyball as an analogy. That's a good one. But I'm a big football fan. And what do they always say about cornerbacks? If a cornerback gets burned, forget about it. You're on to the next play.
Thank you. I'm going to head out. Thanks.
100%. Thanks for that. Okay, so now it is. Let's see. Not Gnostic. You try again. Or are you still in a bad place, Gnostic? I don't know if he's in a
Nope.
bad
Is this any better?
Yeah, it's better. Go ahead, Gnostic. Go for it.
Okay. Just about everybody's asked my questions already. So Stanley, here's a joke for you that is kind of interesting. I first came across your book when it was literally thrown at my face by one of my bosses who asked me to stop being such an idiot and getting worried about losing. And I read it and thought, this is absurd. And then over time, I've learned that, it's don't get worried about stuff. Anyway, the question here, and I think it's been answered by a bunch of other people. We've got people concerned about cash flows, money flows, EU money flows into America, bonds. Are bonds going to drive the market? ETFs. Is all of that reflected in the price in the market, or is some of it exogenous and has an effect?
No, I really believe it. That's why it was more than just a catch-all phrase that I had when I used to do the professional tape reader in the upper left-hand corner where I said the tape tells all. Well, you just said, which is really good, it's all in the mix. Everything that we're worried about, at the end of the day, it's like making a stew. It's all in there. And then you taste it. It's good. It's bad. That's what it is. And the market is really digesting all of these factors that everybody worries about. It's like that old thing about, hey, if you put a blindfold on and somebody would touch a piece of the elephant, what was that? They touch a different part. It's all in the market, and that's why I try to keep it simple. I think sometimes, and I'm not being facetious, I'll sometimes tell a client, you know what? You're so bright, but I think that's hurting you. And I'm not being eccentric. I know I'm above average, but I learned that when I get in trouble, it's because I'm overthinking. I think sometimes we have to stop thinking and overthinking and just look at the bottom line, because that's the end result.
Thanks for that, Stanley. That's great. We're just going to move along quickly because we have limited time. I'm going to go to Guy Cirandulo, my old friend Guy Cirandulo, and then we're going to have all about the price after Guy. Guy, good to see you. You got a question for Stan?
Yeah, thanks, George. Hi, Stan.
Hey, good to talk to you. It's been a lot of days.
A lot of days. I just have to say, more so a comment. I think, if there was a way of cloning you, Stan, I think we would all have to pray to have that happen, because there's a generation of traders, investors that will learn so much from you. I mean, we would have our calls, Frank and I, at Wellington every 2 to 3 weeks, and it was always phenomenal. You're always, even at your age, I don't know how old you are, but man, you have the energy of a 20-year-old. So,
well, thanks. I just had my 80th birthday. I said to my wife, the calendar's wrong because I feel like 60.
Yeah, good. The one quick question I do have is, I've been on the buy side for over 30 years. You're doing all, your work on the sell side for even longer than that. How do you deal with clients that, may have shorted a stock at the wrong time and not listen to you, or conversely, even the long side at the wrong time? It jams in their face for a day or two. Do you get calls from them?
Of
how
course.
do you handle that heat of the moment? How do you handle that?
Right. I'm sure that you do the same thing, Guy. And that's what I've learned. At this point in my life, all I want to do, first, before I worry about clients, when I was like in my 20s, I would worry about, am I right, am I wrong? At this point, I don't worry about right or wrong. I worry about, am I making the right probability call? And then let the chips fall where they may. Now, turning to clients, I have learned also to just lay it out. I always talk in an analogous form. I'll often say, hey, I can only lead a horse to water. I can't make him drink. I lay out my opinions. People know, like I have a new client, a gal, maybe she's with me 3 or 4 months, and she's not used to me. She's go, oh, why don't you tell me what you really think? The bottom line is I lay out my 2 cents. You are all big boys, big girls. You do what the hell you want with it. And, and that's the fun of it, because I know I'm going to be right 7.5 out of 8 times. At other times, like this gal who I told her, she said, oh, you're terrific. You're the Michael Jordan of technicians. And I like to tamp down expectations. I say, you know what? Michael Jordan puts up an air ball now and then too, and so will I. Give me the space to be 20% wrong. I know I'm right 8 out of 10 times. So I know you do it too, Guy. You give them the best and then let the chips fall where they may.
Exactly. Thanks so much, Stan. Thank you, George. Bye.
Thank you, Guy. Walter Deemer, we're running out of time here. And Wally, I have sent you invite to speak a couple times. It'd be great to hear you say hi to Stan. We have limited time left, so I want the questions to please be tight. No speeches, just get straight to the point, please. So, my good friend Jackson Monero, the floor is yours. What's up, Jackson? Jackson, you there? All right. So let's go to All About the Price. The floor is yours.
Thank you, George. Thank you so much for doing this. Very excited to support your charity. And Stan, it's great to hear your voice again. It's your old friend, Mitch P. Quick question for you on, you talk about the glamour average a lot. What is in it? How do you update it? And second to that, you have an old quote, I won't try to do it justice, about when they raid the brothel, they take the piano player too. What's the piano player in this market right now? Is it Nvidia? Is it Apple? Like, when are we going to know that everything's been completely washed out?
First of all, that's a lot of great stuff. Yeah, and you're right. When they raid the house, they take the pretty girls and the piano player too. But anyway, I think they're doing it in sequence. First, they got the aggressive stocks you saw, and that's what I put out in January. Then there were those wise guys who said, like, oh, even though you're right about that, you're wrong about the semis. Now they're rotating and they're getting the semiconductors. They're becoming a problem too. So this, I don't think is going to be a case of where, oh, they're taking the piano player. Yeah, they're just taking one girl at a time out. So that's number one. And what was the other part of your question? What beside,
I'm
what
sorry,
would,
it was about the glamour average.
oh yeah, that's right. Okay, the glamour average. That's a proprietary thing, no big deal. And you would all be able to put it together too. We put it together. Aggressive stocks. It obviously has the FANG stocks in there. It's got some good go other stocks, biotech, healthcare. What you'd expect. And every quarter I'll go through and say, oh, I didn't used to have Shopify in, so Shopify goes in. We take some old drudgy stock out that maybe isn't rocking and rolling anymore, and that's it. And it really is very helpful, because you'll see that once that ran into trouble in the late December, early January period, after that, from that trading point of view, that's when they got the piano player.
That's excellent question. Wonderful to hear you, Stan. It just brings back so many memories to hear you use to invoke some of your oldies but goodies. All right, let's go to Kurt Sees It All. Kurt, what's your question?
Yeah, no, very quickly, I want to say, George, thank you for putting this on. This has probably been the most insightful space that I've been on in a long time. Having guys like Stan, just being able to share their experience in the market, and it's definitely the most, by far, experiential space I've been on. Second of all, I just realized my question will probably be a little bit too long-winded in regards to Stan. I haven't heard anybody really expanding upon reading the tape. And that's something I'm actually a fan of, and I'm studying now. I'm definitely a big technical analysis trader, but
So
actually,
Kurt, let me
yeah.
stop you right there. I'm hoping that Stan, as skeptical as he might have been at the outset, has enjoyed himself so much that we're going to get him back here, because you asked what is seemingly a very simple question, but that cannot be answered in a soundbite. So you're right. Given the limited time here, if you would please ask that question when we have Stan back. I just don't think it's the right time and the right place for that
Yeah,
question.
no, definitely so, and that's why I realized
Yeah.
that it'd be too much of a long-winded
No,
explanation.
exactly.
I appreciate the space.
That could be the topic for an entire room. So let's just leave that aside. All right, Jackson, are you back, Jackson? Are you back there, Jackson? I don't know where he went. Okay, let's go to Peter. Peter, what's your question, please? Peter, I don't know where he is. All right. Anyone else? Oh, here, you haven't said much. Do you have a question to offer, Stan? Otherwise, I think it's about time we might bring the room to a close.
Can you
Go
hear me?
for it. Yeah, you're fine. Go for it.
Stan, what are your thoughts on precious metals and the sector in general, and mining stocks, if any?
Great. Good question. You'll see in tomorrow's report, those of you who bother to get it, we've been in gold stocks. It went through a consolidation. You don't have to do a lot of thinking. I think it's getting ready to go again. What's interesting, whereas several weeks ago, bullion itself was acting better than the gold stocks. Now, from a shorter term point of view, I see an inversion. When you get a chance, we hang up and we end this call, put up the GDX, the George David X-ray. It's getting ready. Well, long term, it's an easy call. It's bullish. But from a trading point of view, right down this level, 40 spot 30. Right now, it's 39 and change. If it goes topside and we break above 40 spot 30, boom. I think that's a new buy signal, and I think you're going to see a whole new up leg start. Long term, it's an easy call. Short term, watch it. That will give us a short term timing of when the next gold run is going to be. And if you look at the GLD itself, that doesn't look as good now. It's sloppy short term. Well, it's bullish long term, but the GDX, that's the key. Watch it above that level. I think we will get another new up leg.
So Stanley, I just want to make sure I heard you right. You wouldn't buy it. You want to see another breakout before you.
Right, exactly. Now it's a solid hold, breaking out. We buy again. The other thing, though, let me just amend one last thing. This will be the last call. One last question. One last thing. Even within the gold sector, which the whole thing we've been bullish on for quite a while, but there are some stocks like I'm just thinking like an AUI, Apple Uncle Yellow, and a couple of others you'll see in the report that are on the margin that are getting ready to break out. And if they would go topside and break out, like I'm going AUI, if it closes above 5.80, even if the GDX hasn't broken out, I'd buy some AUI. And then if the GDX breaks out, I'd buy it more aggressively. There are others that, yeah, they're okay, but they're not as good. So we have to do a lot of work and not just be, simple minded.
All right. Stanley, the last question again, because I keep getting asked and keep messing it up. Again, your email address is Stan at what?
Here we go.
globaltrendalert.net?
Yeah, Stan at globaltrendalert.net. Just send off your name, send off your phone number. I'll send you the report, and then we'll see where it goes from there. In the meantime, George, this has been a great session. I never thought I'd be on this long, but I had a blast and a half. This was even more fun than when I was on Wall Street Week with Rukeyser. May he rest in peace.
So Stanley, I have one thing I'm going to ask you, and that's just to stay on for like a couple minutes. Carol Stone is a friend, and she has a career in philanthropy, and she is spearheading our efforts to funnel the resources that people want to contribute to World Central Kitchens. And so Carol is going to just speak for a couple minutes. What's going on?
My pleasure.
Yeah, we're going to come out with a bigger. So Carol, we can keep it tight. We'll do a bigger explanation maybe in the next room, but maybe just give a heads up about what's top of mind for you and what we're going to be doing, Carol.
Yeah, I'm going to make this really quick. Can you hear me?
Yeah, I can.
Okay,
we're good. Yeah, we got
my first time on Twitter, Stan. So just like you, but real quick, George made the point about wanting to make sure that a charity was selected that was apolitical and had a high rating. And the other thing that's the World Central Kitchen is really on the ground, not only on the border of Ukraine and all the neighboring countries, but it was important to us to find an organization that was really being effective inside of Ukraine. And the other thing that we'll talk about in another space is that, this whole topic of food, which is the mission of World Central Kitchen to go into disaster relief areas, totally intersects with a lot of the stuff that George and everybody in his space is talking about, namely economic security, national security. So it's just a great charity doing incredible work, small but mighty team on the ground in Ukraine. And we can talk about it more in another space, but just a heads up to look for more.
But by the way, Carol mentioned to me like one of the reasons why we're picking them, aside from the fact they got a really high efficiency ratio and they're apolitical. She was mentioning like they're one of the few that's there. I mean, Carol, what did you tell me? The Red Cross is getting bombed on or something crazy like that?
Yeah, well, the Red Cross had to withdraw out of certain areas. There are also a lot of organizations that can't cross certain corridors without UN reaching some agreement with both sides of the conflict. And so there are organizations like World Central Kitchen that has a lot less red tape, apparently. They're smaller, they're more nimble. And I'll have more color on that when we talk further. But it's a really interesting aspect that there are not that many organizations like there usually are in a national disaster that have been able to be effective inside Ukraine. And this is one of them.
That's fantastic.
This
Carol.
is great. So do me a favor. Just send me an email quickly so I know, outlining the thing and where I make a contribution to and how, whatever, boom, 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 and send it off to me. Say we spoke, and I'll take care of it.
That's great, Stan.
Fantastic.
That's great, Stan.
Thanks, Stan.
By the way, Stan, I mean, like, I know we've all had a lot of fun here. You've taught a lot of people. It is so, again, I don't think you realize the impact that you've had on people's lives. Really?
Well, that's really true, because it's funny. After I did the last podcast, one guy had written to me who became a client, and he said, "You don't realize the impact." Just what you said, how you've changed my life, and da 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 da. And and I turned to Rita. I said, "Hey, I hope I make it to the biblical 120, but you know what? That's part of my legacy. So it always, for me, starts first family, then after family, sports, then politics, and you know what? And then it's this market and whatever. And this is my contribution. Like I say to Rita, there's so many shitty people in the world. I like to just feel. Hopefully, it's a long time from now. We leave this world. We've made it just a little bit better place we came in.
Thank you, Rabbi Stan and Stanley. I hope you'll consider coming back again sometime in the future.
This way we will, not too soon. We will down the road. I got to be honest with you. I thought it would be a bit of a fun, but this turned out to be a hoot. Down the road at the right time, you and I are going to rock and roll again. Again, we're still 1 and 1 equals 3.
100%. And again, on behalf of everybody, thank you. We're going to do this again, and stay tuned. Carol's going to be coming out. We're going to have the YouTube channel up and running soon. And go Global Central Kitchen. So there you go. Thanks everyone.
Terrific, and have Carol send me the email. I got to hop now.
You got it. All right, Stan. We're gonna say goodbye to Stan. Stan, you're just charged. You can go. Is anybody else? O'Hare, unless there's anything else, I think we're gonna close this room. Unless O'Hare, there's anything else you got on your mind.
No, I'm all set. I got just getting ready for a lacrosse game here.
So, hold on one second.
Fantastic.
Hold on. I'm gonna let Gnostic get the last word. Gnostic, what's up?
Stan, if you're still here,
I'm here.
What you said about coming into the room and getting re-energized and feeling better about being in the room, yes, I think everybody in this room would also agree. George runs a tight room. He tells us to basically go jump off a cliff if it's appropriate, and he runs a good room to sit down and do it. He doesn't let us blab too much or get too carried away. Having George around is a huge help. Having you in here makes us all feel better. And exactly what you said. My God, I've spent I don't know how many hours sitting in George's rooms just listening, or in some of the other rooms listening to some of the other people in here, and it makes me feel like there's hope. Please, please, please come back. This has been great, and I've appreciated you for years. And Stan, thank you.
Hey, you know what? You're welcome. I'm going to tell you something. This was a win-win on both sides. It's the essence of a good deal. I hope I helped you guys, and for me, it recharged me. So we all won. Now we should all stay safe and well.
And with that, Stanley, you have the last word. Good night, everyone.